Good morning, everybody. Welcome to Trade Live with IG with myself and Ronnie.
Top of the morning to you, Richard.
The Scandi Viking is in the house. How are you, sir?
Never been better. You know, this is the highlight of my week, coming in here, sitting with you.
No, but I genuinely believe that, because sometimes you can be sarcastic, but tell me a higher highlight.
I can't, mate. I can't. Just this Scottish connection
You're
here.
looking well. You've got a glow about you today.
I do.
Has the lights changed? Or?
I was in Budapest over the weekend.
Ah, what a city.
Yeah, I was there for my first ever stag do, actually.
Oh, dear.
But yeah, the sun was...
So what's coming up on today's show? We'll hear more about Ronnie's stag in a minute, but we're starting with myself and Ronaldo through till 8:35, and then we got an updated, technically speaking, from Axel with all the news that's going on. Axel very kindly coming in to give us a midweek update. At 9 a.m, Angeline's going to open those all sessions. 9:10, a good friend of mine, Michael Syme, coming in. Ex-managing director of Goldman Sachs, now runs, this is just for you, Ronnie, the top company in the UK advising people on their buybacks.
Oh, lovely.
And he investigates into all the company buybacks and see when the banks are
That's why you
doing
have
questionable things.
That's why you have him on.
Just for you, Ronnie.
Just for me. I'll definitely be tuning in.
So that is, anything you ever need to know about buybacks, this man knows it. And so that's going to be really good conversation there. We're going to dig into the practices when buybacks are announced and the process, etc., etc. 9:35, going for gold. Popple's back. That's right, our gold expert. So a real big second hour of the show there with our buyback expert and then our gold expert. So, right, go on then. Were you in Buda or Pest?
We mainly were in Pest.
Pest.
The fun side.
Yeah.
It was nice. I've been there before with my family, so this one was
same vibe this time.
Far from it. But if it was one thing, it made me realize that the sort of party lifestyle is beyond me. I'm not a drinker usually. But I figured, I'll get out of my comfort zone for my friend. It's his stag do.
Get a couple of matches.
Yeah, got a couple of bevies in, a couple of beveraginos with the lads. But yeah, it just wasn't for me. My body totally rejected it.
Really?
Yeah, my tummy was doing backflips. I had Simone Biles down there spinning around. Yeah, I threw in the towel quite early, I have to admit.
So what, did you fly out Friday, Saturday, come back Sunday?
Flew out on Thursday and then came back on Sunday.
Oh, amateurs.
Why?
That's too aggressive.
Yeah, I know. I actually had the last flight back on Sunday, but on Friday morning after the first night out, I called BA and booked the first flight out on Sunday instead.
You changed your flight to earlier. No, it's actually our group. So we've had 8 of us that go away to Marbella, Ibiza, Miami, Vegas, wherever for
still
18 years. And half the group book the first flight out on the Sunday and half the group do like a 2 p.m.
And
it's
which
really
one are you?
I'm a 2 p.m.er.
Yeah.
Like, what's the hurry to get home on the Sunday? You're just going to lie on the sofa and feel sorry for yourself anyway.
Relax, recover, get ready for Trade Live with IG in the morning.
This is a long time before that. This is back in the Credit Suisse days when we were being responsible with other people's money.
Oh, yes. So, you saw how that went.
Right, good morning to you all. How are we doing? Maturin update. How many people have you got on your rogue Discord that nothing to do with the company? But it's very good to see that our viewers are having a way to chat to each other after hours as well. What's the updated figure, Phil? Let's find out. Boise, good morning to you, sir. Good morning away from the numbers. 16 people Cool. That's about as many as comment on the chat. Brilliant.
There you go. We're moving.
15. Oh, Maturin's just chucked somebody out. Good stuff. Right. Who else have we got in? Steve Davies. Good. I'm glad we got a more sunny day down in South Wales today. My first ever girlfriend from Pontypool in South Wales.
Your first ever girlfriend?
16 years old. Yep. And Shrimp Fred saying not firing on all four yet. Maybe that was to do with the speaker. So what have we got to talk about? Well, Ronnie and I are going to, I think we might have opposing views on the US-China trade talks. So
we did have a little chat before the cameras rolled.
Let's go into overnight action and discuss that. Right, Ronnie walked into me this morning and said, "Oh, I hope you're long the US." Why?
Well, because Lutnick has come out, and so has the Vice Premier of China, and come out and said they made great progression.
No, hang on. Let's get the wording right. We have agreed on a framework.
That's great progression.
To resolve the negativity that had come up since Geneva.
Sounds like great progression if you ask me, mate.
The market's above 6,000.
Yeah. We're almost at the levels that we were.
At what point did the market go down when we thought that trade was about to break off again?
Mate, we're less than 1% away from the peaks in February.
Uh-huh. So why buy it on this?
I'm saying because the market will react.
But there is absolutely nothing in that trade talk. We're agreeing to positive growing trade.
Richard,
we had to get rid of the negativity that had come in.
My friend, the market can stay irrational longer than you can stay liquid.
What is new from these trade talks that's positive?
It's going to be headline reactions. Okay, guys, watch.
That's the point. Headline reactions with no substance behind.
I guess that's the first time in history that happens.
That's like, the market can't go up on the initial trade talks, right? That was positive, I'll give you that. 30% was definitely positive, and we broke that live on air.
You heard it here first.
Since then, there had been a clear break from what was agreed in Geneva. And all this has done is fix the cracks that were in the agreement.
But now they come back to the Geneva Agreement. They've agreed to stay with it.
Yeah, but the market's about 10% higher than where the Geneva Agreement was made. So what are you going to buy it on next?
I'm just buying everything. Everything in sight.
Your Novo Nordisk has started to turn. I will give that to you.
Yeah, I mean, I've sort of broken up with it, with Novo Nordisk, unfortunately.
Oh, you have?
Yeah, it was too painful.
Is that the only thing you've broken up with?
It is, yes.
Phew. She was happy with you going on the stag?
Yeah, she was, yeah.
Okay.
Cooked her dinner yesterday.
Right, if we just want to go to today's times then, let's have a look at the action overnight. Oh, sorry, what? I seem to have clicked on the wrong button there. I don't know what that is. Get in, my son. I mean, sorry. The first team from Africa ever to trounce England.
That's what I call true reparations, my friend.
Now we're talking on the overnight positives. Senegal. How are you losing to Senegal? What's going on there?
You know, Rich, you have a supporter. I just got a WhatsApp from one of my colleagues saying he disagrees with my opinion on the US.
Did you say one of your supporters?
One of my clients. Sorry, one of my clients. Well, one of my clients just WhatsApped me saying that he disagrees with me on a technical and a fundamental level.
Good man. Sounds like he knows what he's talking about. Or she.
It'd be your own.
Right. Now, first poll of the day. Before we get into the actual news, we got to talk about this front page story on the Times. London Tech Week. Talk about scoring an own goal. They've turned away a mother and her because she had a baby with her. She tried to take the baby into Olympia and was literally told, "You're not coming in. You've got to leave again." And she obviously had nowhere to put the baby. So there's been an outrage on social media, and she says she was left feeling humiliated. And it's the excuse kind of works out. They say that they don't have facilities, whereas there we go. The spokesperson says, "We're aware to these as a business event, the environment hasn't been designed to incorporate the picture and needs facilities and safeguards." It's like, well, you should have planned it. Somebody should be sacked for that. But if you didn't have it, then all right, do better next year kind of thing. But then you read down to the bottom, and there's a woman who presented at last year's, where is it? Yeah, there's a woman at last year's event that was given a presentation, and she was accompanied by her 6-week-old baby on stage. And she said that it's completely accessible and has dedicated feeding rooms. So today's poll is, should this poor woman have been allowed in to Olympia, to London Tech Week, or was the company right in saying, nah, you shouldn't really have a screaming, crying baby at a business event?
Well, while we get the poll up, I'll share a funny story. When I was very, very young, my mom was working as a translator,
right,
back in Sweden, and you know, we weren't really, you know, babysitters wasn't really a thing. So my mom would take me with her when she would go on these translating jobs, and you know, they would sit there, like I would go with people to the hospital, and they would talk about their problems and like their health issues. And then I would just sit there, and I was like 5 years old, listen to people.
You were 5, right?
Yeah,
Okay,
yeah. And then after that, when she started working as a carer, she would take me with her as well. So I would hang out with these like old people while she was taking care of them. So if you want to, you can make it work. So do better, London Tech Week.
Yeah, but I'm kind of the same. So my mother was a hairdresser, my aunt was a hairdresser, and after school, or I guess it was probably just before I started school, so 4 or 5 years old, I was taken into the salon, and I used to use the big hairdryer thing as a space helmet. And you know, that was just, it's what you did in those days growing up, because there wasn't babysitters around, right?
That's why you're so in touch with your feminine side. I like it.
It's why I don't mind going into a salon every now and again.
Yeah.
Quite comfortable.
Seems like the apple fell quite far from the tree, however.
Right, let's get into the news here. So, front page of Financial Times, we've got Rachel Reeves today. Talking
what's
about
that? US and China agreed to a framework deal.
What does it say? To restore the trade war truce.
We are making great progression in the right direction.
So the Financial Times is saying restore the truce. Yeah, so Rachel Reeves, a story today about what's going to be announced there. Let's get that up. And story one. So Rachel will today put a 39 billion affordable housing plan at the heart of her spending review. She combines a tight squeeze on day-to-day spending. And yeah, it's be interesting. So we've got that to come out later today. Then we've got the CPI. So we just check on today's economic calendar.
It was one company that I think is quite well positioned to gain from these increased spending in public housing is Lloyds Bank, as they've been they've been a big in the forefront, trying to get the you know, their foot into the affordable housing market. They recently announced, not too long ago, I'll dig it up, but they made a deal to finance about 100 billions worth of housing, if I'm not mistaken.
Okay. Wow. Right, let's have a look at that economic calendar then and get the CPI preview. Just having a look at Lloyds. Lloyds is trading. God, it's actually traded back down to 76. That's interesting. A little bit of weakness came into the FTSE yesterday. Oh, you lot that are so hell-bent on buying your Rolls Royce at the top of the market. We said it felt heavy when it opened, and oh boy, did this thing trade heavy yesterday, Ronaldo.
Let's see it.
Rolls-Royce hitting a high of £9.07 before dropping right back. Look at that. So this is when a US seller steps in, right? There's clearly one of the big US long funds that just came in, phoned the bank desk at 2:30 or 2 minutes into the US Open and said, "How we doing, old chap? Tubby, where can I sell $100 million of Rolls-Royce?" And then clearly smashed it to pieces for the rest of the afternoon.
Which I think, I mean, I agree with you. I don't think this drop is rationalized in my eyes. They also just won a government contract to build a small nuclear plant.
Oh, welcome to the party, Ronnie.
So great to be back here.
Did you only get back yesterday? Or?
I got back on Sunday, actually.
Right. What day is it today?
Anyhow, Maturin, tell me more about this Discord.
Right, so there's the story from yesterday, of course, on the Rolls-Royce power station. But what's really interesting is that actually it goes down. It was great news yesterday. It goes down to explain exactly what happens here. So, excuse me for scrolling. Right, how do small modular reactors work? It takes you through the exact process, and it's incredible. I mean, it sounds like it's got real prospect here, but the government and Rolls-Royce have not yet agreed or decided on which areas to put the first 3 small modular reactors. Well, there's only one answer, isn't there?
Scotland.
No, that's what they will do. The first one has to go next to the Rolls-Royce headquarters.
Really?
Yeah.
How come?
Because if they're so safe, then have it right next to your headquarters. Have it right next to your offices and where your people live. That's the first one.
Rich, are you anti-nuclear?
No, not at all, but not in my backyard. The second one has to go next to Ed Miliband's constituency, because it's him that's championing it. So he has to stand up and say, right, I'll take one in my constituency. And then the third one, I reckon they'd put the third one in Monkey Man's back garden up in Sheffield.
Sheffield Wednesday, baby.
But of course, no, they'll end up in Scotland, they'll end up in Wales. Poor Hull. Hull will get
bloody imperialist, pal.
Imperialists, eh?
Hey.
Just the nation mocks us. Well, come on, Senegal. Right, there's the economic calendar. Producer Phil has fixed his errors. And there's the CPI. What time does the CPI come out, Phil? There it is, the estimate, 0.3%. And the core inflation rate year-on-year expected at 2.9.
The Russian inflation rate, that's the one I've been looking out for. That's gonna move the markets, pal.
But is it minus 9.9 or is it plus? Well, why have you got minus next to it then? Come on, guys.
I go on holiday for one weekend.
Exactly,
I
yeah.
come back to this.
Poor Russia's got severe deflation. Right, let's. Should babies be allowed at business tech events? Of course, it's not appropriate. Time always tells. Or what is this poll? What are those answers? Of course. Oh, it's more. It's interesting.
Look, my guy, Paul Trowell came to my rescue here. They have a build-to-rent program with a company they own called Citra Living.
Lloyd's do.
Yeah.
Right. Nice.
Shout out.
So our answers to the poll: of course, babies should be allowed. Only 40%. It is the highest answer. It's not appropriate. 32%. That is fascinating. I would imagine, it's similar.
Yeah.
Should babies be allowed in business class airplanes?
Just to sort of like rationalize it, to play the devil's advocate here. You're sitting there listening to AI talk and you hear wah, 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 wah. It's like on a flight.
I think that would be that would be fair, is to say absolutely come in. We've got all the facilities for you. Walk around the exhibition as much as you like. See your suppliers, because that's what she was there to do.
Yeah.
But you can't go into a Jensen talk.
Yeah. Chuck them off in the ballroom or something like that.
But yeah, there's. I mean, could
Come into the
there be,
club room, producer Phil says. I want everyone to know that. I want everyone to know that.
Good stuff. Paul Trowell, thank you very much for that on Lloyd's. Good. Right. What else we got this morning then? We have the DAX looking down 40 basis points because of the disappointing anticlimatical announcement from the US and China. The FTSE looking down 20 basis points, and US futures dive bombing down 30 basis points. So
That's shocking to me, mate.
how's our gold and such like doing this morning? Let's have a little look. Ronnie, what's the next move on gold? 3,333. Where do we go next? Difficult, isn't it?
Yeah, I mean,
Bitcoin's had a much better week than gold has.
Bitcoin's had a much better week, which you can now trade on Cash Crypto via IG for retail clients available. For me, I think gold is sort of a reflection of the macroeconomic environment, or not for me, just for everyone, I think. And I think it's sort of a give and take. We see stability, gold comes down. We see uncertainty, gold comes up. And it was at the peak of the instability when we saw gold at 3,500. My question to you is, I think we'll sort of stay around this area.
Mm-hmm.
My question to you is, Richard, are we breaking 3,500 again this year?
It's really tricky, actually. I think it's all down to the big ugly bill. I think if the big ugly bill goes through as it is, then gold goes to 4,000. I think if we actually manage to get it watered down and your budget comes back into balance, then yeah, it only goes to 3,500 maybe. But you can't have Rachel Reeves suddenly, oh, here's 39 billion that I've got to spend, and Trump, here's 2.4 trillion I've got to spend. Yeah, exactly.
Where did you find that? I'm genuinely curious, because I thought we had, like, when they came into government, they had a $22 billion headroom.
No. When you're spending money on infrastructure, it doesn't count as real money.
Oh, silly me.
It's a separate pot.
Also,
spend as much as you like.
I'm just a simple immigrant. I don't know that kind of stuff.
Emphasis on simple. Right. Okay, so we are 7:53. We'll take a quick couple of minutes, and when we come back, we're going to have the movers and shakers this morning. We're going to have the upgrades, downgrades, but we are sitting here on 932 subscribers. We don't want Rolls-Royce to catch us up. We're aiming for Scottish Mortgage Trust. That's the one. Hit that button. And it does really help us if you give us the thumbs up as well. So that thumbs up. Now, if we've currently got 110 people watching on YouTube. So why don't we have 110 thumbs ups?
You know what? You'll get one from me right now.
There we go.
Boom. 4.
Hadn't even done it myself. So good stuff. Right, Blake7 saying yes, the Rolls-Royce small modular reactors have to be close to water. That's correct.
Yeah, because that's when they're non-toxic if they're in the water.
Yeah.
That's why I have these pools.
And do you see what they do with the nuclear waste?
No.
They build a chamber deep underground, right? And then the waste just drops down into this chamber and it's sealed. It's great for the earth, isn't it?
Blimey. But more importantly, my man Kukumba, he at least someone here appreciates me.
He's nearly always right.
Nearly always right.
Okay, we'll see you after the break. We've got chart of the day. What is it, producer Phil? No, but is it euros? Is it pounds? Is it dollars? It's a UK stock. Right, coming up is the chart of a UK stock. I want you to be the first person to recognize it and get it into that chat, because I'm going to beat you. We'll see you in 2 minutes. I'm frustrated. I thought Anglo-American as well, but it's not.
He
It's
pretty
not
much
Anglos.
listed every UK stock while you doing the commercial.
Well, I'm told it's not Anglos. I still think it probably is, but yeah. Let's see the guesses again. Sorry, I can look at that. Legal General, no.
I know which one it is.
Do you?
Yeah,
How?
because I'm smart, mate. I'm smart. I do this for a living.
Can we get a clue? Not the industry.
It's not to be confused with a high street retailer.
Ah, Smith's Group.
Get in, pal.
I would never have got that, I'll be honest. Right, we've got 5 seconds until we open the London Stock Exchange for the day. Ronnie back from his stag. What was the highlight?
Coming back to you.
Right, let's find out what is moving and shaking today.
Shaking and
That's the
baking, party
miners. The
people.
miners up in a straight line there. Anglo-American, you can see I was with you. I got confused that it was Anglo-American as well.
Is that Lloyd's
like
Bank? I see.
That is Lloyd's Bank up 60 basis points. You're moving markets, son. Moving markets.
Well, after they've been pounded during the week. Oh, what do we see here? Prudential, very nice. Anglo-American, Rio Tinto. The miners are having a good day. It's sort of it's a bit of a defensive day, is it not, Richard?
Yeah, it's a tricky day, isn't it? It's you don't really know where to go because ahead of the CPI at 1:30 this afternoon, there's not much to go on really. So Weir Group up 1%. They've been awarded a £40 million sustainable tailing contract. Bless you, Ronnie.
Thank you.
Oxford Bio also up 1%. Strong commercial momentum. And Ricardo up 20%. WSP's offered £4.30 a share to buy Ricardo. What have we got on the downside on the frequently watched? Oh, it's M&S. They've restarted their online operations, so you can get your vest and pants again.
Yeah, I mean they lost a couple of £100 million in the whole process.
But insured for it? Apparently they're insured for it.
Well, one would hope so in a modern cyberspace age. Yeah, I mean, Marks and Spencer, you know I like this stock. I like them. You shop there, you get your entire wardrobe and your caterpillar.
I tell you, they call in the caterpillar, but the socks,
Clearly.
I think the socks are unbeatable.
I need to get on that because my socks always break. Okay, but let's focus on the markets. That's what the people came
Right,
here for.
defense, continuing to see money come out of defense. BAE Systems there. All it is a little bit of top slicing.
Yeah, I mean,
A bit of top slicing.
it's nothing to write home about. And these companies, these defense companies, have been rallying as like we've never seen before in the past period. So a bit of a pullback it's more than normal. I don't think it's cause for concern in any
Vodafone
sense.
72.70 after that dividend. So it's put that back in at 75p. It is off the high certainly. We'll be talking about buybacks at 9:10 today, but Standard Chartered up 2%.
Sorry.
Standard Chartered and the Pru top the leaderboard today, along with Lloyd's. Glencore strong, as are Anglos. And
It's nice to see. I mean, it's quite expected to see the builders up there. Vistry, Berkeley, very, very strong. And Burberry Group.
the Barberries, £11. They've managed to sneak up without us noticing that.
That's a bit of a comeback there, mate.
That's a real comeback. £7 all of 6 weeks ago.
I think you and I have to stand corrected on this one. We weren't very bullish on Burberry, were we?
No, well, we've got a second chance Sunday on Gucci. Would you buy Gucci now?
Not even with your money, mate.
Not even in the demo account.
Not even in the demos.
Bayer up 2.3%. Mercedes-Benz up 1%. I heard a very funny joke about Mercedes-Benz. Probably not for on air.
I've said worse, don't worry.
See it true. SocGen up 1%. Rheinmetall up 90 basis points. And there's Kerching, 183. Are we? If that goes up to 200 in the next few months, I am going to. Don't know what.
Don't look at me, mate.
What should be my punishment for standing and watching a stock and never touching it?
I think you should hold your hand over a candle, sort of, until you can feel the pain.
Imaginative, very imaginative. Porsche. And yeah, rounding up all those autos. So Porsche, Renault, Mercedes-Benz,
What's driving the so-called European auto comeback?
Yeah, I don't know actually. Should we let's check where the wider market is and see if it's just a beta play or is it actually? Yeah, there's you go. Germany unchanged. with the FTSE strong again. Look at that. Oh, Ange is going to be loving that one. 8888.
Do you see 9,000 this year?
9,000. You've seen 9,000 in a couple of weeks.
Okay, what's the peak this year?
Of the FTSE?
Yes, that's what we're talking about.
Okay, yeah, that sounds like a good poll.
Yeah.
Make up some numbers.
Okay, producer Phil, let's do 9,000. Yeah, 9,000, 9,200, 9,500, or 8,500. Ooh.
Oh, Helen Chesterton there on the chat. Music to my ears. We hadn't noticed that one this morning. Smarter Web Company, new highs. £1.7 to £1.10 is the market. £1.8 trading. So Smarter Web, new all-time highs. We're on the breakout there, aren't we? Woohoo! £1.10 bid. £1.10 bid.
You still on that?
I am indeed, sir.
What was your entry?
The first one was 31. Maturin's got a better entry than me. Maturin got in at 22.
There's someone at this company who had a very good entry.
Here we go. So £1.10. Oh, I think I've got to let
While Richard grumbles over and trying to figure out how trading history works.
No, I was letting some go. I think you can't be greedy.
Never.
Greedy. You got to leave some on the table for the next man.
You never go broke taking profit, my friends.
Yeah.
But for those of you at home who are looking...
And it was a small amount. Top slicing.
Something to pay for the caterpillar. For those of you who are looking for additional companies who are operating in this space, one company that just recently listed in the US and was 20 times oversubscribed for its IPO. They don't do Bitcoin, but they do stable coins, and that is Circle.
Yes. No, that is fair. That's fair.
So that's something to have a look at once the US market opens. We had a few clients who called in about it actually, so that's how it got to my attention.
Yeah, because can we, as clients, can we get access to IPOs?
So IG does not offer that you sort of get in at IPOs, etc. But if we're aware of it, or if you call us in prior to the IPO, we can try to get it up as soon as possible within the sort of IPO time.
They were very, so this was trading from the second it opened.
Yeah.
So I did check it that day because it was only up 83% at the time.
Only.
But it's gone again. To be fair to it, it has gone again. 105. It closed at 88 on that first day, and now trading 105. I don't know enough about it to.
Well, it's the same sort of area. Always do your own research. Don't trust me. Don't trust Richard. Do your own research.
Absolutely, do your own research, especially on these things. But I'll now, Mr. Fox Haig. Mr. Fox Haig dropped a question in yesterday, so I have to do. Where does the FTSE land at the end of the year? Oh, it's the end of the year we've gone for, not the highs. Yes, Arthur Fox Haig asked yesterday that he doesn't really understand the model because either you can buy one Bitcoin or you can buy 0.15 of a Bitcoin. And that's essentially what you're doing by buying something like Smarter Web or MicroStrategy, you're buying 0.6 of a Bitcoin. But the problem is that when you buy a Bitcoin, you've only ever got one Bitcoin. Whereas when you're buying shares in a Bitcoin treasury company, the theory is that that Bitcoin compounds on itself. So you go from owning 0.2 to 0.4 to 0.6 to 0.9 to 1.5 to 2 to 4. So in a matter of months or years, you will have 4 Bitcoin rather than 1 Bitcoin through one of these vehicles. That's the theory.
And what about the dilution of the stock with all the convertible debt?
Yeah, so that's the great thing is that when you're trading at 8 times your NAV, you dilute the stock by 10% and you increase your NAV by 30%. It's just math.
The more you learn, the more you know.
Until it does, and it works until it doesn't work.
Yeah, I mean, there was some guy who did something similar. What was his name? Madoff?
Michael Saylor.
Madoff something?
No, Ronnie, that's completely, that doesn't make sense. Because he had no assets.
Well, right. I think time will tell who ends up holding that bag.
But it's very simple what they're doing. They've got assets. They tell you what the assets are.
Agreed. Very volatile asset, albeit.
Bitcoin is a volatile asset, and that's why you can do much more of a convertible bond in it, as Michael Saylor does. I think you should watch the Michael Saylor, Jordan Peterson interview that came out last night.
Oh, two of my favorites.
That might teach you a few things about what strategy is doing and why it's a $110 billion company.
Well, here am I sitting here with you on a Wednesday morning, so maybe I should listen to them. But just to move on, my good friend Away From Numbers he's raised something quite interesting in the comments here. Vodafone struggling despite buybacks and odd rally today with no buybacks. You know what? Who would have thought? Not me. Not me.
How many are they actually buying, though? Have we checked that? Have we checked the facts, Ronnie?
I've opened Pandora's gate here.
We checked the facts.
I'm sorry, everyone.
Have we even looked at an RNS?
In the meantime.
Oh, no, he is. He's buying 18 million. Yeah. No, that's fair. No, the stock is going down. Well, I tell you what, if only we had an expert in buybacks that will teach us why it's not going up.
Interesting. In the meantime...
That was a plug for the 9:10 slot, by the way. The Goldman Sachs guy that's coming.
Everyone drops off after 8:30. We all know that. So, thank you, Steve Davis. So are you. Some big movers today.
We're holding out for a hero.
We looked at the big miners, Anglo, all of those.
Yeah.
But some of the smaller names in that sector, Hochschild?
Hochschild. Yeah.
Hochschild Mining up 4%.
Wow.
Greatland Gold as well. And ITM Power up 5%.
Is it really again? Wow. Wow. Yeah, I think we should, we're going to have to join this Discord just to see what people are talking about and then start talking about that on the show as well, give the price updates because, yeah, we've got some of the stock ideas that they've been mentioning recently have been absolutely incredible. ONDS of Monkey Man's up 70%.
Do you wanna enlighten me?
Well, let's have a really quick look. Oh my goodness, is spot platinum up 4% again? Wow. Let's have a really quick look at Commodity World. So we've got, Brent crude at 666. And so we've got gold at 333 and Brent crude at 6666. Woohoo! And then what was it, 8888? Rolls Royce?
I don't know, mate.
Oh, the FTSE. And the FTSE's at 8888. Whoa. What are we living in? Right, platinum. Is that real? Is that... Let's have a look at that because that's...
What's driving that, Richard? You're the big commodities guy.
Do you know what? I haven't seen what's actually doing this, but it's had an incredible few days. Yeah, look at that.
Oh, wow. Blimey.
Okay, so let's have a look at Valterra, then, our newest...
Is that the Anglo spin-off?
And it's up another 4%. Why didn't I buy this one? Oh, that is really, really frustrating. We talked about it on the show. We watched it, didn't buy a single share, and it's gone from £27 to 34 in a week.
Lesson of the day. Less yapping, more buying.
Yes, true. Oh, dear. Right, Eric Jones saying his license plate as a teenager over in the US was 666 GEM. GEM. I actually had an ex-girlfriend that chose to set her locker password as 666 as well.
Ooh, that was a red flag if I've ever seen one.
Yes, it was. She dumped me in the middle of a nightclub on Valentine's night.
Oh, damn. I'll give you a hug after the show, don't worry, mate. But, fuck.
But I did meet Jedward the next morning on
Jedward,
my flight home, yeah.
they still alive?
Well, they were at that point.
One thing that is really rallying, wow, Vistry Group up 7%, mate. The builders are really taking.
They are. Is that from the headline in the Times then?
It must be. Well, I mean, if Reeves is saying that she's gonna invest 39 billion in their sector, then yeah, I would assume that they would rally based on that.
Yeah, there's no story out, so good. Right.
Very interesting.
Excellent. Okay, so let's take a quick 2 minutes, let you go and get a cup of tea, and we can get an update on the outside Discord chat. See how many
How's it going with
members there are.
how's it going with our Discord chat? Are we getting that launched?
Somebody update him, will you? We'll see you in 2 minutes.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees, with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Welcome back to Fast Markets, the part of the show where we take some of your ideas and we make them our own, or offer you some options which might reduce the risk, because that's what we're here to do, Ronnie, isn't it?
Yes, always risk management. Richard, monsieur.
Well, so let's give a little update on my Tasty account. What options positions have I got on at the moment?
DJT.
Well, I got a bit of DJT on there, yeah, just for some upside.
Never meet your heroes, guys. Never meet your heroes.
The Palantir is one that we've spoken about, so I am short 2 of the August 160 call. That means
That's rational.
that I am happy to short 200 shares at 160.
I'll take that.
Yeah.
You know
what was
what?
that, 30 grand?
Yeah, you know what?
Stock.
That's
So yeah,
Decent trade.
it's decent, and I received $8 for that. So that will be a total income of $1,600 for that. If Palantir don't get up to 160.
You might even afford to retire then, mate.
Rob, retire. Who wants to retire? I tried it for 4 years. It's boring.
Well, isn't it time for you soon?
So then, watch it, or I won't let you into Olympia for London Tech Week. So then Robinhood, of course, did not get into the S&P 500 after their gigantic rally. So I bought a little bit of a put ratio. I don't think they'll go down that much, but I think they'll go down a little bit. And they have so far. So we've made nice progress on that one. I bought 3 of the $75 puts and sold 9 of the $67 puts. And I also sold the 90 calls because I don't think they get up there. And that's for this Friday. So just a nice little 3-4% sell off in Robinhood. Ching ching.
Cha-ching. Richard,
See if we can
Richard, I have a
take
question
out
for
Maid
you.
Marian at the weekend.
I have a question for you. We talked about it earlier. Novo Nordisk.
Yes.
What shall I do on my demo account? Let's get a chart up. Let's begin with getting a chart up.
Okay. When I think about trading pharma, I just think back to all the horror stories that are involved with them. So Novo Nordisk, let's have a look at this chart. Nobody thought that this thing would have been hurt quite as much as it has been. Look at that. Is that not just classic, everybody jumped on board a theme of if you're a fatty, you can get more streamline? And everybody jumped on that, didn't care what premium multiple they were paying, and it's just come back down to where it should be.
So your conclusion is do nothing?
My conclusion was it should never have been up at 1,000.
But
Was it knock?
DKK. Danske kroner.
It should never have been up
Danske
there.
kroner for helvete.
So yes, 700, fair enough. 700, I'll take that.
But what's interesting is that if you look at the Eli Lilly stock, which is, the close competitor, their stock hasn't been doing anything close to what the... what's going on with that chart?
Yeah,
What's going
that's
on?
the old sessions.
Mine doesn't look like that. But the Eli Lilly one, it hasn't been moving the same direction, right? They're not having the correlation. So my question is, as we see more adaptation of this, we see integration into the the NHS as preventative healthcare, whatnot. Which one do you think will come out as a winner in this? Is it Eli Lilly or is it Novo Nordisk?
So that's
Or little curveball. Is it one of the off-brand ones, Hikma Pharmaceuticals?
I wouldn't know enough about Hikma.
Okay,
Do you know much about Hikma?
I just know that my dad's name is Hikmet, so it's quite close to it.
My goodness me.
Right,
tip ranks.
Eli Lilly or Novo Nordisk? That's my question.
My natural reaction would be Eli Lilly,
Yeah.
but that has always been throughout. So I don't know if I would now change because of the valuation on Novos. But we are seeing, the analyst community are saying 23% upside on Eli Lilly. And you've got quite a consensual look at all that. They're all saying that this thing can go to 1,000, and
above.
I must admit I do agree with that. So that's Lilly's. So let's go back to Novos and see what's going on there. Do we get tip ranks here? So normalized P 21, dividend yield 2%.
21, that's quite high for a pharma stock.
tip ranks 16% upside. Yeah, 16% upside. We're just Eric Jones just
breaking news.
saying.
Breaking news, guys.
Is that new news, Eric? Is that just come out though? He'll be asleep, won't he? Ah, right. Yeah. So Elon stepping down from his podium.
And it's been fact-checked by the Holy Trinity in the production room.
Yes. Yeah, so it's Chaos saying that, and also Eric Jones backing up as well. So that's two sources that we've got. That's enough for us to run with the story. And does that do anything? I think had we already decided that was fine anyway?
What do you mean?
We already decided that Elon Trump had been resolved when they stepped down on Monday.
Yeah, I think we've had that that was sort of the truth. But now I think this is sort of the olive branch.
Yeah, him apologizing. Okay.
Yeah.
Apologizing for some of his comments.
Some of his comments. If someone has a link to an article,
it's on Sky News.
It's on Sky News. If you've heard of them,
yeah.
Small indie company, please post in the chat.
Yeah.
Okay. Yeah. Well, let's.
Is it priced in?
Buy more Ronnie. I agree.
Buy more Ronnie if closes above. Ah, is that Novos? Anyway.
Yeah. Oh,
right.
That's what he meant.
So
is Tesla
Elon.
the next? Tesla is next.
Well, yeah,
let's jump to Tesla. Fast markets. Tesla.
It's
called fast markets for a reason, mate. Tesla.
All right, let's go Tesla then. What do you think? What's your view? I mean, this is what I'm saying. Is Elon's already priced in. It's back to $325. It's it was at $350. Okay, so maybe that's a bit more. I would worry that my CEO was capable of
as an indicator. So the all sessions opens at 9, but as an indicator, the German listing is up 5%.
Right. From how was yesterday afternoon though? Yeah, this thing 4:30 was.
I want to say that it's
so 2% new move, a 2% new move on Tesla.
I want to say it's a nothing burger.
Shall I give you what the experts think?
Well, you're already here, mate. You already told me what you think.
So, we have got.
This is my heart to you, Richard.
We've got two sides of the argument here, right? Morgan Stanley. Despite the political heat, Morgan Stanley reiterates Tesla as its top pick in the US autos with a 410 price target. And they push this dreams idea.
With the drones?
No, it's data, robots, energy, AI, manufacturing, space, right? So that is the Tesla. Yes, drones are becoming more of a chatting point on it. We struggle to think of any other company as well positioned as Tesla, right? That's Morgan Stanley. Wells Fargo, Tesla has 60% downside from current prices over the next 12 months, as Q2 deliveries will be expected to be down 20% year on year. Price target of $120. So 120 versus 410.
What's the timeline for that price target?
12 months.
Oh, because I have until 21st of June for Tesla to hit 150. Otherwise, I own the sales executive in Stockholm, a T-bone steak. So if they can get down to 120 in 10 days, I'll be happy.
God, you must have been excited last week, though, when that all started. I think most people are expecting Q2 to be not the best. The question is, how bad is it relative to expectations? And Robotaxi launch counteracts any level of meaningful decline in sales. So that is the chat from the Feingold chat this morning. Nick Feingold, of course, came on here, gave the argument for Tesla, and everything, outlined the path towards that 410 target. But that's an interesting one. And then, as I say, Jordan Peterson interviewing Michael Saylor last night. If you've got a view on Bitcoin, if you want to hear what his view is on Bitcoin, then very much worthwhile. And that's on bitcoinnews.com.
I'll watch that after I finish
bitcoinnews.com.
I watched that after I finished my Andrew Tate interviews.
How much have you made from Bitcoin?
Shall I have a look? Oh, my phone's not here with me. I'll pop it in the chat. But last time I checked, I was up 12%.
Brilliant.
And also
What percentage of your pie is it?
Next question, please.
So are you a believer or not?
I'm a believer in the fact that someone will pay more for it than I paid for it.
Right. And do you think the guy who's created a $110 billion company off the back of it's worth listening to?
You know what? I would listen to Enron on energy advice back in 2000 as well.
Good answer. Right, we've got Axel coming on next. It is 8:31. Get your questions in for technical elements. Is it gold? Is it Tesla? We'll take a really quick look at, now it was what was the stock? Maturin wanted to look at IONQ. IONQ, we'll have a really quick look at this because it is, of course, the quantum computing angle. And
it looks like a bridge.
It's come back, isn't it? Look at that. It has, it's gone back towards the highs. So the momentum building in this sector.
It's a very long-term play, quantum computing.
Yeah.
So, I mean, as of now, these sort of stock prices in quantum, they're sort of fueled by news and developments.
Mm-hmm.
It's not anything practical or tangible.
Yeah.
So it's just the headline risk is too much for me. You know, Jensen comes out and says we're 15 years away and the whole sector tanks. Then he comes back and says, you know what, I was wrong maybe. And then the whole sector comes back. So yeah, too much headline risk in these ones for me.
It's, if you're a futurist, then it's interesting to be involved. But what you're saying is take a well thought out percentage of your overall investment.
Yeah,
plan.
I would say it's something for the ISA.
Don't bet the house.
Yeah, something for the ISA, I'd say, rather than the spread bet account.
Yeah. Yeah, no, that makes a lot of sense. Good stuff. Right, Axel coming up next. Thank you very much. I am off to, go and get our gent down from downstairs. Mike will be here. And then later on today, what are you up to, Ronnie?
I'll be maximizing client value generation and shareholder value on the phones.
I'm off for lunch with my good friend Alexandra and Melissa. The last time we were out was in New Zealand, and I think we made it till about 3 o'clock in the morning. So we'll see you tomorrow morning.
Cheeky.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hello and welcome to Technically Speaking on, what is it, Wednesday the 11th of June. Let's get straight into it and let's look at a chart of the Nasdaq 100 because I've had lots of questions about that and about today's CPI number. Now, if you look at CPI, I mean, what tends to happen nearly always is if the inflation rate over the last few years, at least in China, is higher than expected, also US CPI comes in higher than expected. It's just a correlation I found. So if that is the case, what we could see is a higher print than expected later on today, and that could potentially lead to quite a significant sell-off, unless the markets just reinterpret any bad data as, you know what, we don't really care, it's all still good, which is what's happened so far over the last couple of weeks. But if you look at the chart, what we can see here on the Nasdaq 100 is that we've been losing upside momentum. Can you see here the bars and candles basically are getting shorter, and we are still in this uptrend, we're still on the uptrend line. And it is still heading higher, but we are within this key resistance area, not far off the all-time highs made back in December of last year and also in February of this year. So we could see further upside take us through those highs. But what worries me slightly is what I've been saying over the last few weeks. Can you see here we've had a series of higher highs there on the daily chart, but a series of lower peaks here on the relative strength index. So that potentially, because it's called negative divergence, could lead us to have at least a short-term reversal to the downside. And perhaps today's CPI data will be the trigger for that. Now, if you look at the range the market's been trading at, what you can do here is click on here and go onto the average true range. And you can see here this average true range. And I use a 10 period for the last 10 days. The range, the true range, so including gaps over the last 10 days, that tells you how volatile the market is. And it's also useful to place your stops, for example, 1.5 or 2 average true ranges away from where the market is trading now. For example, if you're long, and if you believe the market will continue to go higher, what you can see here is if you go down to the bottom of this, the average true range over the last 10 days on the Nasdaq 100 has been 278 points. So if you use an average true range of 1.5, you would probably place your stop loss around 400 points lower than when it's trading now. So that would give you a lot of space for volatility to increase somewhat. But if it were to increase too much, as we saw, for example, at the beginning of April, then you would be stopped out with this sort of average true range stop loss. So I use average true range stop losses because they tell me when the volatility is clearly increasing. You saw here in April around Liberation or so-called Liberation Day the average true range went to over 1,000 points on the Nasdaq 100. So that was extremely volatile. And that was a period where we should have decreased our trading size. A lot of people traded the same size and got blown out in this movement here. But now that the average true range is back to basically where it was before it all kicked off, as you can see here, we've got what is called normal trading environment. So the question now is, what is our support? What is our resistance? As I showed you before, we still have an uptrend line in place. That in itself isn't really that helpful at the moment because we're just grinding higher. But if we were to fall through here today, if the data were to disappoint, and if, that's a big if actually, the market were to interpret a higher CPI print as negative, then we would probably fall through this uptrend line. But that in itself is not enough for me to then think, oh, this uptrend is over. What I also would like to see is probably a major reversal, take us down to below the 5th of June low, and ideally actually this low here on the 23rd of May. So that for me is a line in the sand for the medium-term trend, but as you can see, it's a long, long way away at 20,660. So as long as we stay above here, the uptrend is still very much intact, even if we were to see gyrations going forward. And from a short-term perspective, as long as the 5th of June low holds, this uptrend is still in place. As you can see, we have a series of higher highs and higher lows, which is the definition of an uptrend. And the price action is always more important than any oscillator you want to look at or things like that. So let's go and look at some charts you want me to look at. eBay is the first one on the monthly chart. So let's have a look at eBay and let's see what the chart tells us. And you can see it's an all sessions chart. And what we do, we go on to the monthly chart because that is what Monkey Man wanted to look at. And let's see what we've seen so far. We clearly see here a hammer formation followed by another bullish month in May. That is bullish. And you can see eBay has now seen 4 consecutive months of rising prices, even though we had this huge dip at the beginning of April. And we are heading towards the all-time high here, which was made in October of 2021. So from a monthly chart, this chart looks very healthy. Also, if we were to see a reversal to the downside, we've got all these highs going back to January, February, and March of this year on the daily financial beta around 7,100. That area should act as very strong support. So what we do when we go from the monthly to the next lower time frame, we look at the weekly chart, and you can see eBay has just been going up and up and up and up every week, and then last week accelerated to the upside. So the trend is your friend. Don't fight the ticker tape, is what people used to say back in the 1920s and 30s. Same nowadays, don't fight the trend. And if you look at the daily chart, you can see here that also looks very healthy. We have a series of higher highs, higher lows. And if we were to draw a trend line on here on the daily chart, what we can see is that we remain in a very clearly defined uptrend. We're actually moving away from there. So even if we were to retrace, that would probably represent another buying opportunity. As I said before, on the monthly chart, we've got all these highs going back to January, February, and March here. This area here is very, very strong support. And you can see that's why it held here for a while, because that was resistance going forward. And we were finding it difficult to break through the resistance. And once we've done that, we accelerated to the upside. Quite often it's normal to then retest that previous resistance area, which now, because of inverse polarity, is acting as a support area. And then you can head higher again, but sometimes that doesn't happen and we just continue to grind higher. So eBay looks very bullish. Yes, we are overbought, but a market can stay overbought longer than you can stay solvent. So here, for example, you can see in September, I mean, if you were to go short, for example, it was overbought in September. And yes, it stayed overbought for quite a while here, but the trend actually continued quite significantly for another 6 weeks or so before we had a major correction. So that in itself doesn't mean that we are likely to come off. Right now, eBay looks still quite bullish. I've got another question to do with JD Sports. Let's have a look at JD Sports. And JD Sports fashion, here we are, is, let's go onto the monthly chart because we looked at that. Let me get rid of the ATR because we don't need it now. We looked at this, I think, quite a few weeks ago, and you can see that we were heading down for several months, and then we had, for the first time, a bounce off that support area, which happened around the December 2018 low. Can you see here? Previous lows quite often in the future act as support. So look on your charts for previous lows. And since then, we've had 2 months of rising prices, and at the moment we're coming off again. So on the weekly chart, we, despite that rise we saw for several weeks, remain in a downtrend, because you can see here the 30 period simple moving average capping the upside, and on the daily chart we are finding it difficult again to head higher. So we went up here to 95, and then we've come down again, and right now the downside pressure seems to be more important than the upside pressure, because you've got a series of lower highs now and lower lows, which is the definition of a downtrend. So I wouldn't be surprised if JD Sports were to fall through the 5th of June low, in which case we could retest this support area here around the 80 mark, which is what we're doing now, and perhaps down to 77.68, the low seen here on the 2nd of May. But if we were to take out that low from a technical perspective, then for me the odds would be greater that we could actually slide further again and perhaps retest the 71 area or so, going back to mid-March of this year. In which case we could have formed what is called an ABC zigzag correction, and then perhaps we could hold there and then go back up again. But right now the pressure seems to be towards the downside. What would change my view is if we were to rise above not just the last reaction high, yesterday's high, because that was a small doji here, but the next higher one, so the high on the 29th of May. If we were to rise above that 85.52, then perhaps we formed a minor bottoming formation here, and we could be heading back up again towards the 95 area where the mid-May high was made. And then if we were to take that one out, you go to the left and look at the next higher price action going back to January of this year, and that was around 104. So right now, for me, JD Sports looks to be short-term more bearish than bullish. I've got another question to do with another company, IONQ, and let's have a look at this. So what we always do with our analysis is start from the longest time frame available. And what we can see here is a monthly chart. And you can see on the monthly chart, we've had 2 bullish months, and the last month was very bullish. And if we go onto the weekly chart, what we can see here is that we've had a retest of these previous highs, except for this spike high here in December of last year, and in January of this year, sorry. And we then came off that resistance, as you can see here, a few weeks ago. Then we've got this doji week, this indecision week last week. But on the trend perspective, if we look at the trend, what we can see here is that we remain in an uptrend. So what do? I basically connect the trend from the lowest point on my chart here to the next lower point, this one here. But if I were to do that, it would be more or less horizontal, so it doesn't really make sense. So I take the next higher low, this one here, and just connect it up with these highs here. Now you can see here, this would look fine, but we've got this data going through it. So we need to just connect this support line now, because we've got 2 touching points. But it's nearly also an uptrend line. As you can see here, we're very close to these lows here with the uptrend line. Well, this is correct because no data is going through here. A lot of people, what they do is that they basically draw trend lines incorrectly. So let me just show you what I quite often see is this sort of thing, where you connect these highs up. Yes, fine, but can you see here you had data going through that? When that happens, it's not necessarily a trend line break, because the trend lines become less steep with time if the trend basically loses some upside momentum, which is totally normal. Well, what you want to look out for is not just a trend line break, but a fall through the last reaction low, or the last important low. This is the last reaction low. It's also the last important low. Why? Because suddenly here on that day, we managed to break higher very, very quickly. So we had a huge impulse move to the upside. So this is technically significant. So a fall through there would indicate that that uptrend may have come to an end. But in the meantime, it might never happen. What you do is you need to redraw your trend line from the lowest point to the next higher low without any data going through it. You can see here there's no data going through it. That's the correct trend line, which ties in with the 30-period simple moving average. We can see here we've come off and we're now trying to go up again. So basically for me, from a technical perspective, provided we stay above the 5th of June low and more importantly, the low here on the 22nd of May, which on the daily financial bet was at 3,314, this uptrend very much remains intact because we have a series of higher highs and higher lows, even though we've had this huge reversal to the downside in the short term. Now, as long as that's the case, we should remain bullish. And if we manage to get above these highs seen at the end of May, we should then retest the January high, which was made at 5,467, and perhaps head towards the 5,500 area. Let me just see whether we've got any thoughts on the DAX. As you know, I love trading the DAX. It came off for the last few days. It seems to be holding today. It's bouncing back. But what we can see here is potentially a hammer formation forming today. But, and this is the important thing here, can you see this hammer here? It's similar to this one. You can see here if we were to close higher, that could be a bullish reversal signal if you have a daily close above it on the candlestick on the next day. Now here we're still forming this candle today. So this could look totally different by this evening, could look like this if the inflation data comes in much stronger than expected. And therefore you can't read into this and just say, okay, it's a hammer, I'm going to go long now. So what you need to do is look at the chart on a daily perspective, and you can see that we've broken through this previous uptrend line. Now, it may still be a valid trend because what we've seen is, yes, a loss of upside momentum. And yes, as on the NASDAQ 100, these higher highs, by the way, last week we made a new all-time record high. These higher highs have been accompanied by lower highs on the relative strength index. So basically, we've got triple negative divergence. That warned us that we could see a reversal to the downside, which is currently taking place. But this may already have been it. And then we might go back up again, make a new all-time high. We don't know that. It will really depend on what the CPA data will say later on today. But from a technical perspective, where's our support? Well, the last relative low is the low from the 2nd of June, which on the DAX was at 23,733. As long as we stay above there, this is just a sideways trend with a bullish upside momentum still in play here. And we could see a retest of those highs and new highs. Now, if we were to fall through that high on the 2nd of June, the next lower low is the important low here, which is the same low on all the charts. It's the 23rd of May low. That's when we had a big decline here before we had further upside. So that for me is the line in the sand for the DAX from a medium term perspective. Provided we stay above that low, which was made at 23,268, for me that uptrend remains intact. If we were to fall through here, then basically we could have a reversal to the downside, which could be quite significant. So look at the 23rd of May lows on your charts because those are quite important. Now, because I've got another quick question here, I'm not going to just wrap up. The question is, can the software show watermarks for the stocks? It's hard to understand if you do not know about what the stock we're talking about right now. I don't understand your question, sorry. Can I put a watermark in the middle of the chart? Oh, okay. I guess I can. I need to know how to do it because I don't trade on IG because we when we're employed by IG can't trade on the platform. So I'll have to ask somebody how to do that. But yes, I mean this is IONQ all sessions. But yes, let's do that in the future. I'll put a watermark on there so that you know what I'm talking about. Sorry about this. Thanks for watching Technically Speaking, and I hope to see you again next week. Thanks, bye.
Bring me the next shiny new thing. Bring me the next shiny new thing.
So today we're on set filming our latest ad campaign for IG Invest. IG Invest is the latest innovation from IG. It's aimed at those who are interested in investing or maybe have a bit of knowledge but want to become more experienced. And what we've done is created a really beautiful, easy to use app, and now we've got to publicise it, and that's what we're doing today and trying to capture. So we worked on this ad campaign with Otherway, who are our creative agency. And what we really wanted to do is think about breaking down the barriers to investing. And so we wanted to think of an idea that was playful, fun, but also inspired empowerment.
So essentially, like, a lot of financial advertising can be quite dry, a little bit kind of wallpapery. And I think the idea was just to create something that was really eye-catching and kind of use that distinctive IG red, but put it in this really interesting metaphorical space where investors felt really kind of calm and kind of very effortless in what they're doing.
So my work is colorful, it's poppy, it's quite surreal, and I think this is one of the projects that is a perfect match. It's really nice to have a company that's very brave in their approach, and I think as a creative, as a potential target audience of the whole thing, I think it's going to work very well.
There were too many people to name who've worked on this project. You know, at IG, it's really important that we move at pace whilst delivering really high quality work. So we've had to have the best brains in the business on this one, and we really hope that you like the result.
It's been a real pleasure working with IG. I think ultimately as a brand, they're really keen to push things and kind of take the financial kind of advertising space somewhere slightly more interesting. So it's been a real joy for us to work with them and help them kind of get there on their journey.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hey, trader friends, welcome back.
back to the show, and we are counting down to the all sessions. My favorite bit of the show here, of course. You know, this is where we see the IG platform come onto its own, because you can take your positions ahead of the US Open. How many more seconds to go, Cam? 15 seconds to go. I'm just looking across the board here, looking like quite a mixed session so far across the indices. What will it be like on the all sessions? I got the bell ready. 2, 1. And off we go. Here is what it's looking like out of the gates. It's still really starting to settle there, but Tesla up more than 2% there. We also have Tilray up more than 1.8%. Lots of volatility seen on Tesla there. Monkey Man, you on that ride. JD.com is up almost 1%, and IonQ, a lot of the quantum names there also up there. This coming, of course, in a time when there are no details, trader friends, no details, but there are sounds that the Americans and the Chinese seem to have agreed to continue talking about some sort of deal, but no details yet. To be honest, we weren't really expecting any details, were we? Let's take a look at the losers list. GameStop, all sessions there, down more than 4%. We also have eBay down 1% there. Upstart Holdings, Block, Walt Disney. Walt Disney, a big consumer there, name there, down 0.5%. Rich and I often talk about whether Walt Disney is starting to have that little Nike swoosh. Is it starting to come back up now? Home Depot is down 0.5% as well. And we are seeing Hims and Hers down 0.25%, along with Broadcom too, down 0.33%. So some of the consumer names there looking like they're not having too good a day. Crossing over to the main indices, just to give us a look at that. I'm going to zoom in for you. We are seeing a bit of risk off there. To be honest, not surprised, given that we saw that agreement between the US and the Chinese officials to continue talking, but it all really lacked details. Traders, of course, keeping an eye as well on NVIDIA. Just showing this for you because it is all sessions on the IG platform. And I'm going to whack that up there for you. It is currently down 0.1% there. Those of you trading the stock, keep an eye out for anything that comes out from the Viva Tech across in Paris. And this is, of course, where he is likely to explain what further products are coming down the line. It's his keynote address. Jensen Huang will be making his keynote address at the Viva Tech conference. I wish I were there, but I would rather be here talking to all you people. I will be patching in to that after the Viva Tech. Cam, Director Cam in my ear going, really? Yes, actually, because it's always a scrum in those sort of locations, and I've been there, done that. Not so sure I want to do it anymore. Global markets, as I mentioned, having quite a mixed reaction there. Going back to that space, we are seeing across the board risk off there after that news that the US and Chinese had this tentative consensus, shall we call it, on trade. What that really means, trader friends, is they're going to continue agreeing to continue talking, to be seen talking. And now we are going to see negotiators apparently seek this approval for framework of talks to take this forward from the US and Chinese presidents. All this coming after Asia Pacific markets climbed overnight. Let's have a look at some of the individual movers. Crossing over to my watch list there and bring up the FTSE 100 there. Taking a look at some of the gainers first. We've got Vistry up 9% there. Barrett Redrow up 2% as well. And we've got Persimmon, and we've got Rolls-Royce also up 2%. Taylor Wimpey up 1% as well. Now, some of the house builders gaining because we are expecting news out of the UK today. Andrew McKelvey, Maturin, Jugger. Any of you trading the house builders, please let me know. Jesse 14 seems to have gone missing. Jesse 14, are you there? I've sent a mug across to you, an IG mug, because you won the last number of the week. But let's have a look at the watch list of house builders. There you go, Jesse, if you're listening. Or Jessica, rather. Let's have a look. We have, across the board here, the house builders having a risk-on day. And this is because they're all waiting on Rachel Reeves' speech on public spending. Expectation is that the government is going to rubber stamp a 10-year program to build lower cost housing, up to the tune of £39 billion. This is almost doubling the annual spending on affordable homes. But haven't we been here before? Just wondering if all of you are thinking the same thing as me. We often hear this, it's like a perennial thing. Government's going to increase spending on building more lower cost housing. However, then there is this issue of not enough land or not enough brown land that's been converted into land where these house builders can then produce all this low cost housing. Still, we're seeing home builders in terms of the UK house building index up some 2%. Ahead of this expected announcement. Right, Andrew McKelvey saying, I have all those names there on the chat. Wow, Barrington Development as well in your portfolio, but don't really trade them. Is this in your pension, Andrew McKelvey? Let me know. Monkey Man, thank you for remembering. I had a coffee outside. The second one was a decaf because otherwise my doctor's going to be very upset with me. But thank you for asking. And producer Phil's going to be upset with me if I don't get my next guest in. We're going to talk about all things gold. So stay with us because we got Simon Popple coming up next.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
What Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Welcome back to Trade Live with IG. I have Mike Singh in with me this morning, former Managing Director at Goldman Sachs and Head of Execution Sales. But now, well, first of all, welcome.
Thank you very much.
Tell us.
Pleasure to be here. My first day on TV ever, so please be kind to me.
We can't promise that. Once we get onto Vodafone.
Yeah.
But yeah, we talk a lot about buybacks on this show. Ronnie jokes around, you know, we talk about Vodafone a lot. So this is the #1 expert on buybacks in this country, if not more.
I think you're being very generous. I would definitely not say that, but yeah, I'm trying.
And you've branched out into your own business, haven't you?
Yep.
Which is, we call it an advisory.
Technically, I'm a consultant.
Consultant.
In order to be an advisory, I need to be licensed, and I haven't set my business up as a licensed regulatory body just right now, not for any particular reason, but I don't need it currently. So I consult.
A consultant, and really diving deep into why, well, one of the things that you're looking at the moment is why this country trades at such a discount, the stock market, the companies, and what can be done about that. In fact, we can put your latest piece of work here, which you were very kind to send me. We'll see that up on the screen. This is a publication about time to tilt the scales, a call to help UK capital markets.
Yep.
Now, give us a bit of background and then what this takes us
Sure. So by background, I'm an equity execution guy. So what that means is historically, I've helped investors when they make a decision to buy or sell a security. Don't ask me what you should buy or sell. I'm hopeless at that. But once they've made that decision, how to efficiently transact it. And by efficient, what we're really looking at is how to not spend as much money as you otherwise would. So if you've got £100 and you want to try and buy, whatever it is, Vodafone, I want you to try and help you buy as many shares as possible for that £100, including all of the transaction costs and all those sort of things, and just try and do that efficiently.
Yeah.
So since, I sort of have spent 30 years helping customers do that in various different ways across lots of different types of customers, lots of different ways of transacting, from portfolio trading, algorithmic trading, etc. My last role, I was running the execution service of a relatively small business, and we sold that business to a very large investment bank.
And was that Redburn?
It was involved in helping to manage Redburn, and I was responsible for their execution services.
Right.
And we sold that business to a company called Rothschild & Co.
Right.
And in that transaction, one of the things that the Rothschild & Co. bankers wanted me and my execution team to help them with was to build pitch books to sell the execution services of the new broker that they had bought.
Yeah.
What was going to become their equity department, if you like, to try and help corporates do transactions. And it was, they were interested in pitch books to try and help with share buybacks.
Yeah.
And that was when I sort of first had a real proper look at and trying to understand how does the market execute buybacks and how are things set up. I'd done a little bit before, but really I wasn't really involved.
Because it is very complex, isn't it? But I remember, 2011 it must have been, I was doing Rio Tinto's buyback.
Yep.
So about $2 billion over the 12 months.
Yep.
but we were buying up to 100,000 shares a day with a target of the VWAP. And anybody who doesn't at home doesn't know VWAP, it's a very technical term used in banking that is just the volume weighted average price. So my target was to beat this average price during the day, but you could cheat, because if the stock went down, then the company would just send another 50,000 shares to buy. So you always looked good against this VWAP. And there's a lot of ways that banks are helping themselves look very good in these transactions, isn't it? And the cost that you detail in this article is astronomical.
So, yeah, I mean, if we go back to what am I trying to do, and then I'll bring it back into that process. So I'm trying to help corporates, when they transact in their own shares, do that efficiently. So if you want to buy £1 billion of your own shares, which is the average FTSE 100 company buys £1 billion worth of their own shares a year. It's just a little more. So last year, I think it was 54 FTSE 100 companies executed a buyback of larger than 1% of number of shares outstanding, so a significant buyback. And the cumulative value spent was about £57 billion. So, right, each one, that's an average, as opposed to, like, Shell alone is buying back, I think it's $15 billion a year, $3.5 billion a quarter. So that, multiply that by 4, is that 15? Something like that. Anyway.
Yeah.
So when you look at those sorts of transactions and measure them through the eyes of how would an investor think about transacting a buy order of that size, and you measure things from that perspective, I estimate, and it is an estimate, it's definitely not based on hard data, but people can challenge me on this and have challenged me on it, and we walk away going, okay, that's fair enough.
And it comes from a lot of experience.
And there's a bit of experience behind it, yeah. And I estimated at about 7% on average for these very large transactions for a buyback executed in the UK.
Yeah, so that's the cost to the
total cost for everything, which is borne by the shareholders, because the shareholders own the company, right? And by comparison, somebody else, Man Group, estimated a similar process for the S&P 500 in the US and came up with a number of about 3%. So if my guesstimate is close to right, which I think it is, then there's a 4% difference for every dollar that you buy back in the UK versus the US. So now that doesn't cause a valuation discount, right? We have a lot of problems in the UK right now where, if we look back the last 18 months to December 2024, so last December, we lost a net 115 companies listed in the UK in the what we call a primary listing. As a percentage, and we ended the year, I think it was with 972. So that's more than 10% of listings lost in 18 months to December.
And that's
this year.
Takeovers.
Correct. Delistings, moving listings, takeovers, take privates, M&A, all of that stuff combined. And it's devastating from the UK's perspective, because our financial service industry, whether you're in private equity or whether you're in public equity, whether you're in debt or anything, we need to have healthy public markets to be able to function. And the first thing you need for a healthy public market is investors willing to risk their capital. They expect a healthy return in order to be able to risk their capital. Right? If they get a better return for the same risk somewhere else, they will do that. And the second thing you need is companies who are looking for that capital to come and regenerate your public market, so that we have more companies coming to market than leaving our market. Otherwise, we shrink to zero. And that has has an awful negative value to our country, right? So it's really important, much that people will like to dislike people in financial services, it is a pretty critical business in our economy in general.
That's what my mother always said. She said, you don't listen to these people that say about you being a bad banker. Look at all the tax that the industry pays to the government. It's an astronomical amount. So this is an important part of the economy. But welcome to live television, because we've got a question right there. Why do companies pursue buyback programs in the first place? And your publication does actually go through the reasons for that.
So I'm an execution guy. I'm not a capital allocation guy within a company. So Don't take it from me, but this is kind of what I've learned, and I'm very early on my learning curve from a corporate finance perspective. Yeah. But if a company has excess capital, so it can afford to return some of that capital to shareholders, then it has two choices. It can return it via dividends, or it can return it via share buybacks. And there are reasons why share buybacks may be more favorable, or dividends may be more favorable. But generically speaking, if your company is trading, the share price of your company is trading at a discount to what people think is the fair valuation, then share buybacks they transfer wealth to the remaining shareholders from the shareholders who choose to sell.
And you do that because you're reducing the share count.
The share count. So if you've got a company which has got 100 shares outstanding and it wants to return £100 to those shareholders, if it did it via a dividend, each shareholder would receive £1. Right? It's pretty simple. So imagine you owned 10 of these shares, so you are a 10% holder.
Yeah.
If it wants to return the same £100 but do it via a buyback, it has to go and buy those shares from the share register, from the shareholders, and it can do that in a number of ways. If it does it through the market, what we would call an open market transaction, you can't actually buy the share from the selling shareholder, because the selling shareholders will sell it to the market, and you as a company have to buy it from the market, which is where these rules you were coming into talking about before, right? There are rules as to how as a company, you're allowed to buy the shares so that you don't get accused of manipulating your own share price.
Yeah, absolutely.
Those sorts of things. So, when that enters the equation, the company has to go and buy shares from the market. Now, that's a technically challenging thing to do. It's easy for £100.
Yeah.
It's very different for £1 billion because the share price, it can take a long time. The share price can move around. But these companies typically don't have internal trading expertise.
Right.
So you can imagine if you're an investor, so you're Warren Buffett's, Berkshire Hathaway, or you're Fidelity or whoever.
Yeah.
If you want to buy £1 billion of something, you give that to your internal trader, and their job is to protect your interests and to try and turn that into as many shares as possible in a risk and cost-efficient manner, right? I mean, that's a very specialized world. Absolutely. And this is where you and I used to live, right? With one way or another, we were involved in this process. And there are lots and lots of tricks. The buy-side trader, as we would call it, this person, the investor who's looking after this transaction, their job is to understand how to do this as efficiently as they possibly can. And the intermediaries, so the brokers in general, hopefully not the broker who the buy-side trader is transacting with through that on that day, but the market's job is to try and extract as much value from those orders as the market makers, all these people. They provide a fantastic service, but their job is to try and make money from other people trading.
Yes.
That's what their job is, essentially. And so there's a game going on, and it's complicated, and it has lots and lots of different layers and cleverness and complexity and stuff like that. And professional traders, their job is to understand how to not get taken advantage of or abused or whatever you want to call it. A corporate, when you actually go and talk to the corporates, this is, they don't know what they don't know. They don't know the tricks of the market.
A huge information disadvantage.
Yeah, massive disadvantage. And when you talk to these people, they're IR or they're treasury or they work within the finance department. They're fantastically competent people, but they just don't know the tricks. And so they're vulnerable to being taken advantage of, and it happens a lot. And when you think about the scale, and we're just talking in the UK, 60 billion or 57 billion pounds last year. If you can make an extra 10 basis points or 50 basis points or 1% from that, and I'm saying it's about 4% in total, that's a lot for the market.
And that's just the 4% compared with the US, and it might be going on there as well.
Oh, there's games going on in the US too, for sure. The US is not a perfect model, but I picked it because it's deemed to be a more competitive market.
Yeah.
So that's and then also I can find the data for somebody else's work.
Why is there a 4% gap, Andrew McKelvey's asking, between the UK and the USA, and is it being sorted?
Okay, there isn't a 4% gap. This is me estimating a 4% gap, so it's not factually right process. So I think the reasons why, I think the fundamental, most obvious reason why there's a big gap is what we would call information leakage. So these transactions are big. if you're a US listed company and you want to do a buyback, your board has made a decision and approved a decision to return capital via a buyback. The only disclosure you need to make is when the board makes the approval, which is a permission to the executives that you can do a buyback. And that's disclosed through AGMs and publicly disclosed, as it should be, right? We can't have a company transacting in its own shares without the shareholders knowing. That would be very unfair.
Yeah.
But now that's a permission. They don't need to do the transaction. They have an option to or a choice to do so. And if they choose to do so, they don't have to tell the market until their 10Ks and 10Qs, so quarterly numbers after the fact. So, you know, there's an advantage when you're trying to buy £1 billion of something that the market doesn't know you're starting to. Okay?
Absolutely.
So in the UK, the way we've set up our safe harbor rules and where companies get the legal protection from being litigated against or challenged from a legal perspective, the rules say that if you want to do a share buyback and stay within the safe harbor, when you take that permission from your board and turn it into an intention to buy, before you buy a single share, you have to disclose. So what you'll see in what we call the regulatory news, so the RNS,
We've got an example here. We'll pop Vodafone up.
Okay.
And you can see, this. Not only do you get the pre-announcement that it's going to happen, but you also get daily, down to the very share, how many shares they've bought, which means people like me and our other viewers can try and take advantage of it.
Correct.
Because we know on a half-day bank holiday going into Christmas, they're trying to buy a whole day's worth of shares.
Maybe.
And the stock goes up 3%.
They don't have to, but they can.
Well, that is what happened.
Yeah. But the point is that before a company has to buy a single share, they have to tell the market, we're going to start buying £1 billion of our own shares, or whatever the number is, today. We expect to finish, there's a series of things, minimum things they have to explain. And then every day that they do a transaction, they have to update the market on how the transaction is done. And if you look, you'll also find what we would call every single X lot. So every single child order. So, at 8:04 in the morning, right after the market is opened, the company might buy 1,000 shares from the London Stock Exchange. And at 8:05, they might buy 1,200 shares from Aquis. And you have to disclose all of this. So anybody who knows what they're looking at, so you and me, we spend our lives in this stuff, get a very, very good idea of what's going on. And that does lead to opportunities for totally legal front running, which I think is not the way that we should design the market if we want to try and protect the long-term investor. Absolutely. So the question to the regulator really is, who are you trying to protect? And you have to make some judgment balances as to who you're trying to protect. I think this particular disclosure law is excellent, insofar as they're the best disclosure laws in the world, in my opinion.
For transparency.
From a transparency perspective. But the cost of having it near live has a tremendous cost on the company and therefore the remaining shareholders within the company. So I would propose that we keep the level of transparency, but we delay the information so that you get it a quarter later or something like that, so that the value of the transparency is there, but the trading value has diminished. Those sorts of things. Now, I'm just proposing it. It's not like I've based this on any fantastic study which will say this is the optimal one, but I'm just saying it will be an awful lot better. And it's the same as what we have in the US, so it's an easy thing to copy.
Yeah. And it's just like when we used to get taken out of $50 million of something, then you could keep the print back for a certain number of hours until the next day.
Yeah.
So it's that on a...
It's that, but the scale of these transactions is just dramatically bigger. The single biggest orders in our market on the buy side certainly are share buybacks, without a shadow of a doubt, in aggregate. So in answer to your question, the 4%, I think a lot of the differential between the UK and the US is to do with this disclosure stuff. There's other reasons. There's two other reasons, I think. One is the execution products, but to be frank, they're no better in the US, but it contributes to the total cost. In fact, you could argue that they're worse in the US. I don't know why I'm pointing over here for the US, but where I sit at home, this way is west. And then the other one is the way that we've designed the access. So if you want to try and buy a lot of things from sellers, you need to try and find where are the sellers going to be selling it. And within our market, as you probably understand, your listeners probably understand, we have lots of different mini exchanges within the market.
Yeah.
So we've got London Stock, we've got these things called dark pools, and all these sorts of things. You want to be able to go where you can buy the shares from the sellers, and most of the sellers over time tend to be the professional money managers is where, most, not all, but if you go and look, by percentage of ownership, the vast majority is owned by professional.
Yeah.
So you want to be able to go there.
And then just going back to Maturin's question, so to underline your view and the view of obviously the companies as well, it does benefit the company if they perceive the share to be worth less than the market or worth less than the valuation would otherwise suggest. So cancelling the shares does help you have a bigger EPS.
It does, yeah. So if I can steal from Warren Buffett and just explain that why it makes sense and when it makes sense to do a buyback and when it doesn't. So if we take Warren Buffett, and apologies, Mr. Buffett, because I'm gonna steal your idea and probably get it.
Far worse here.
Probably get it wrong. So imagine we have a 3-share company. You own 1 share, I own 1 share, and Mr. Buffett owns 1 share. So it's a 3-share company. And the total value of the company is £3,000.
Okay.
Right? So we don't need to worry about how we value this company. You don't need a super analyst to come and forecast future earnings and do discounted cash flows or you know exactly what the value is. It's £3,000. There's no question. And the company wants to do a buyback, and I choose to sell my share. My share has a value, the moment per share value, of £1,000. But the company, says, Mike, we'll offer you £800. And say I really need the money because I need school fees or something like that, whatever it is, and I sell at £800.
Okay.
What's happened is, and the company then buys that share, cancels it, so it becomes a 2-share company, and I take £800.
Yep.
What you get left with is a 2-share company, so which has got a market cap of 2 shares times 800 is the price, right? So it's a £1,600 market cap company based off the last price, but it has a value of £2,200.
A perceived value.
Correct. Now you used to own a third of it. You now own 50% of this, right? You owned 1 share at the start, 1 share at the end, but the value of your share, not the price, has gone up from, your ownership of the company has gone up from £1,000 to £1,100, right? So the point is that if the company, it was the company that bought my share, not you, not Mr. Buffett, the company, if the company buys my share below its intrinsic value or its asset value or its NAV, whatever value process you're using, then it transfers wealth from the seller to the remaining shareholders because you own the share. Now, if we did it the other way around and I agreed to sell my share to the company at £1,200, then the residual company is worth whatever that is, 1,800, and your shares are worth 900 each. Right? So the value transfer happens the other way.
Got it.
So it's really important at a board level, and I think boards really understand this very well, is that if you're going to approve a buyback, you should only approve it at a price which you have reasonable confidence that it's at a discount or at least not higher than the value of the company.
And that's one of your main arguments, because so Mike has an amazing LinkedIn that he produces a lot of publications, research, and
research would be generous,
yeah.
Opinions.
But you take real situations where you've seen what the details are and cannot believe that these companies have paid.
Yeah, no, it's less to do with, I have no idea what valuation is. I mean, in theory, I know what it is, but I'm not an analyst. I wouldn't be able to tell you if Vodafone is undervalued or overvalued. I wouldn't have a clue.
Yeah, or BAT.
BAT or anything, right?
Yeah.
But what I do understand is how to efficiently transact. So maybe I should explain. One of the things I'm very critical of is that there is a subset of structured products which typically investment banks sell to corporates, which are very clever and look fantastic, but there are a whole series of tricks. And I mean a whole series of tricks. Maybe I should explain that. Okay, so the key component within all of this process is, what is the execution benchmark, which is used to calculate if the execution was better or worse than, and often the profitability for the broker, the fees are arranged from a performance perspective, so that they make more money if the execution is better than the benchmark. And the standard benchmark is what's called the arithmetic average of the daily share price. So if you have £100 million, and let's say you agree it's going to take 100 days to transact, what that means is that you would effectively end up buying £1 worth of shares every day for 100 days. Okay. Now, the important bit is that in the contract, it's very, very clear. It says that we will guarantee an outperformance or a matched performance to the arithmetic average of the daily share price. Now, the arithmetic average, or simple average of the daily share price, is day 1 plus day 2 plus day 3 plus day all the way up to day 100, is that share price summed divided by 100 days. And that's the arithmetic average. It's a common average that we all think. Now, the trick is that I was looking this up. I put it in ChatGPT, how many different averages are there in the world? And it came up with 13, but said there's a whole bunch more. So you've got medians, you've got Bayesian mean, you've got all sorts of averages. The trick is in understanding that. So can I try and explain just the difference and where the trick is from that process?
Oh, please.
Okay, so imagine we've got a super simple, so I'm going to pick a really super simple example. You have £200 to buy in a share buyback. And because this particular share I'm going to pick has extremely high share price volatility, which means the share price might be 50 one day, 100 the next day, 30 the next, right? It's going all over the place. And I'm deliberately doing that just to be able to show you in the maths. And, you agree with your boss, look, because this thing is moving around so much and I have to buy £200 worth, I'm going to buy £100 on day 1, and then let's wait a month, say, and then I'll buy £100 of shares on day 2. And you agree with your boss that, okay, what a good outcome would be if you beat the average. Okay, so you come to me and I say, I've got a fantastic product for you. Okay, so I understand the problem. You've got £200 to spend. You want to spend £100 on 2 different days. I'll tell you what, I will guarantee you a 1% discount to the average price over those 2 days.
Okay.
Deal. Yep. Okay, you're happy with that, okay? So just to be clear, if the share price is 98 on day 1 and 102 on day 2, the average price will be 100, and I will guarantee you that I will sell you shares at £99. So you will buy them at £99 per share, 99p, right? So that's a 1% discount. Happy? Right, should we sign the contract?
Deal.
What I've agreed, and you have agreed with me, is the arithmetic average of the share price. Okay, now let's look at what happens. Can you see this? If I hold this like this?
Yes, that's a bit higher. Up to your,
okay,
there we
fine.
go.
Okay,
Perfect.
so what we've done is, on day 1,
and in front a bit like that.
Like this, okay.
Sorry, in front of your chest, under your chest.
In front of my chest, okay. I got to write on this in a second. So on day 1, we spend £100 at £50 per share, and I'm going to end up buying 2 shares. Okay? First of all, let me just ask you, do you think I lost money or I made money in this transaction? Optically, it looks like I lost money, right? Because, the average is 75, and you bought them at 74 and a bit. 0.3, whatever the number is.
Okay, so the company looks clever.
So it looks like this was the average price, and you bought them at just below the average, 1% below. So do you think I've made money or lost money?
You as the...
Me as the broker.
The broker.
Guaranteed you this 1% discount to the average.
Well, it looks like you've lost money.
Optically, it looks like I've lost money. Okay, I would agree with you. And this is what I was feeling. I only figured this bit out this week.
Right.
Which I can't believe. I read about this 3 years ago, but I have a sort of a degree in maths, different stories, sort of. So I thought I understand averages, which is the arrogance of knowing stuff, right? So on day 1, I have bought 2 shares. On day 2, I spent £100 at 100, so I buy 1 share. So in total, I have spent £200 and I've bought 3 shares. What's the average purchase price? It's 66. Okay, so I've 0.6, whatever. So I've bought shares at £66 and I've sold them to you at £74. So I've made 11, 12%, whatever that difference is.
Huge.
It looks like magic. Now, It's because the arithmetic average is not the representation of what you would get if you spent the same value every day for 100 days, or for whatever the number was, or for 2 days. That average is called a harmonic average.
Right.
Which I'd never heard of until this week.
So the harmonic average is generally lower than the...
The harmonic average for a buy order is always the same. Oh, I've finished that, so
okay.
I've got a new one. I'll spare you my little... I'm not a teacher by any stretch.
Yeah.
But the harmonic average cannot ever mathematically be higher than the arithmetic average or the simple average.
We saw this happen because in VOD's buyback, and we track the number of shares every day, they had an average of 16 million to buy a day. And it was perhaps one of your former employers that was doing it. And they came out and they bought 30 million shares day one. And I was, wow, they're only meant to buy 16. 30 million shares day two.
Yeah.
Day three, 36 million shares. And I could not understand, but that was at 66 pence. Next thing, the share was 70p.
Well, yeah, the point I'm trying to make is that would require predicting the share price. That is, there is a genuine risk in this. This one, I didn't do anything clever as the broker. I just executed, £100 a day at the market price. So the difference between...
that's why you bought 2 lots of 50.
That's why I bought 2 lots of £100.
Right, gotcha.
So the point I'm trying to make is that the cleverness in the contracts at their very base level, before you start to add all the bells and whistles, which trust me, these things get super complicated. But before you even start, like the broker, by taking zero risk, is guaranteed to not lose money, assuming that the share price is more volatile than the 1%. But if I guaranteed, no discount, but I'll guarantee you can never be, and you said yes, then what I've done is I've basically given you a simple average when I know that I'm going to get the harmonic average. And I know by definition, because of mathematically, it's impossible for the harmonic average to be higher. And I'm buying
the light bulb went when I realised you were promising to buy 100, you were spending £100 a day.
Pound is the value. Yeah, if I'd spent shares, it's different, right? But
so you
because it's a value, exactly. So that strategy, execution strategy, where you spend the same value every single day, is called a pound cost averaging or a dollar cost averaging. And the correct way to calculate the price at which you will buy the shares is the harmonic average.
Got it.
Not there. So all of these contracts, of which I don't know what portion, but I'm told it's a very significant portion of the 60 billion pounds a year here, the 250 billion euros across Europe, the $1 trillion in the US, use this benchmark, which is the mathematically incorrect benchmark for a dollar cost or pound cost average price. So I don't know how you feel about this process, but when I figured this out, I felt a bit cheated. I'm like, okay, well, the guy just cheated. His or her understanding of the fact that it's like, if you ask me what's a Bayesian average, I wouldn't even know where to start. I just don't know. But because I don't normally do this stuff, they've taken advantage of my ignorance for no risk as a starting point, and then they build risk onto it and all this thing.
But made it look good.
So I think there's a problem coming in the market because of this sort of stuff. Because the amount of money we're talking about is enormous. I mean, genuinely enormous amount of money.
Now, Mike, you've got a website. We're going to have to dash, but if we can just show the website there up, and it is candorpartners.net.
Yep, candorpartners.net.
And people can add you on LinkedIn.
And if I can make a wish, if you're a company board, I genuinely think that you need help insofar as an expert sitting beside you who understands some of the way execution, because if I can't predict what will happen, but it doesn't take a rocket science to figure out that there could be some legal action coming at some point in some way. And I think it's the board members who are technically at risk for this stuff because, they are unwittingly they don't know the right questions to ask. And so my business is to try and help boards and investors in companies make sure that when a company is trying to return capital to its shareholders, as much of that capital returns to the shareholders and improves shareholder return, and less of it goes to the intermediaries who, whose game it is to try and extract as much of that value as possible. So that's my business, and I would love to be able to help.
Mike, thank you so much for coming in. We've got our gold expert coming up next. We're going to go later today, right? Because we've got Simon Poplin. So we'll go to 10:15 and Angeline's going to chat all things gold. Coming up in a quick 2 minutes. Michael, thanks so much.
Thank you very much.
Bring me the next shiny new thing. Bring me the next shiny new thing.
So today we're on set filming our latest ad campaign for IG Invest. IG Invest is the latest innovation from IG. It's aimed at those who are interested in investing or maybe have a bit of knowledge but want to become more experienced. And what we've done is created a really beautiful, easy to use app, and now we've got to publicise it, and that's what we're doing today and trying to capture. So we worked on this ad campaign with Otherway, who are our creative agency. And what we really wanted to do is think about breaking down the barriers to investing. And so we wanted to think of an idea that was playful, fun, but also inspired empowerment.
So essentially, look, a lot of financial advertising can be quite dry, a little bit kind of wallpapery. And I think the idea was just to create something that was really eye-catching and kind of use that distinctive IG red, but put it in this really interesting metaphorical space where investors felt really kind of calm and kind of very effortless in what they're doing.
So my work is colorful, it's poppy, it's quite surreal, and I think this is one of the projects that is a perfect match. It's really nice to have a company that's very brave in their approach, and I think as a creative, as a potential target audience of the whole thing, I think it's going to work very well.
There were too many people to name who've worked on this project. You know, at IG, it's really important that we move at pace whilst delivering really high quality work. So we've had to have the best brains in the business on this one, and we really hope that you like the result.
It's been a real pleasure working with IG. I think ultimately as a brand, they're really keen to push things and kind of take the financial kind of advertising space somewhere slightly more interesting. So it's been a real joy for us to work with them and help them kind of get there on their journey.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hello, trader friends. Welcome back with me. And Simon Popple is back by popular demand, director of the Gold Program.
Great to be here.
Scare you off the last time.
No, well, gold is continuing to fly, so still very topical.
Yeah, it is. And I mean, just whacking up the chart, trader friends, this is what we are talking about here. It is still shining there. As you can see, we've seen a bit of consolidation recently, but it has broken past that 3,300 level and approaching the second area of interest. You see my rectangles there, Simon? I like to draw that for our trader friends because they understand where the support and resistance lies, where the interest lies. And if we break through the second rectangle where my cursor is, we could then move towards highs last seen in May. But the key question here is the big, beautiful bill. We talked about this earlier. If it passes, you know, what is clearly we're going to see more spending, obviously, and this is expected to boost prices. But what if we get a watered down version?
Yeah, I mean, I think that, first of all, the US is a massive driver of the gold price. Whatever happens in the US seems to determine, what happens to the price. And the bill will certainly, I think, spending will go up, and some of that will feed into spending on gold. But I think you need to look at the sort of the key drivers of the gold price. The MIDI we discussed last time of market uncertainty, inflation, debt, and interest rates. And I think all four of those are working in gold's favour. So obviously we don't know what's going to happen, but I think the price is more likely to go up than down.
You talk a lot about MIDI, don't you? Trader friends, we've talked about this the first time he was here. These are the levers. Lots of people go, and so many things, there's so many factors to think about when trading gold. But we like to keep things simple here. So you've got an acronym that's really interesting. Just run us through this.
Yeah, no, sure.
MIDI.
I mean, MIDI is just trying to keep things really simple. As you rightly point out, there's lots of levers of the gold price, but MIDI, if you look at, again, look at the US, but market uncertainty, inflation, debt, interest rates. So if you look at those four factors, if they are in favour of a higher gold price, so more market uncertainty, like, the tariffs, no one knows what's going to happen there, inflation, if that goes up, debt, I haven't heard a single argument as to why that's going to come down anytime soon. And interest rates, which is an interesting one, because on the one hand, there's pressure to bring them down, but if inflation's going up, it's quite difficult to bring them down. But I think that if you look at those four factors, will it give you 100% guidance on what's going to happen to the gold price? Absolutely not. But will it give you a strong feel for where it's going? I think it does.
Yeah.
And so...
And that strong feel, especially when you talk about debt. Let's whack up my chart right now. It's no surprise there. Take a look at this clock that we often watch on the left-hand side here. I mean, there's no sense, no mood music that suggests this is coming down anytime soon, right?
Yeah, and absolutely. And I think it's one of those things where, debt will continue to go up, and I've got a chart on my website that shows that over the longer term, as debt goes up, the gold price goes up, and it's a pretty simple relationship.
Yeah.
So if something happens where suddenly the US debt comes down, then I think that's certainly something we need to look at, but I haven't heard any credible argument for why the debt will come down. So
yeah, and if this bill goes through, it's another $3.8 trillion to the federal debt that's expected to be added over the next decade.
Well, exactly. And on the one hand, it's great that they'll be spending more on various things, but unfortunately, it's paid for by debt and not taxes. So higher debt, I think, good chance it could lead to a higher gold price.
So let's take a look at the price of gold. A lot of people saying, hey, Ange, it's had such incredible returns, right? We've seen gold prices gain a huge amount over the last few years. I mean, since 2000, the figure you like to always sort of talk about is in British pounds. What is it, 10%?
It's over 10.6% per year since 2000. So for over 25 years, the gold price has gone up on average over 10.6% a year, which is, it's pretty good. Lots of people going, well, is it too late? Is it too late to jump in now? Have all the gains been had? I kind of think, in my humble opinion, with all these factors still in the pot, still in the mix, it's not too late just yet. What's your view on this? No, I agree with you. I mean, I think 2 points. First of all, look at MIDI. Is market uncertainty coming down? No. Inflation.
Yeah, it's
debt,
still going up.
Interest rates, you know what I mean?
Yeah.
If you look at my website, the gold program, I've got a tab on gold price projections, and this is really looking at history. and looks at some forecasts done by Incrementum. And I think that, first of all, they've shown they're pretty good at forecasting, and secondly, they've given an idea as to where the gold price will go, and I think that could be really, really exciting. So no, I don't think we've seen anything like the top of gold.
Let's talk about some of the ways to get in. So let's say you're sitting there, with a cup of coffee, and you're saying, okay, well, I'm really interested, and I would like to get in if you haven't already. I made this special chart for you to try and illustrate different ways that you could gain exposure to gold. So let's take us through it, Simon. Let's start on the top.
Yeah, I mean, I think you start off with physical gold.
Yeah.
I think that's the lowest risk. Incredibly liquid. If you want to sell your gold, you can sell it, pick up the phone with your dealer and sell it straight away. Probably get cash in your account within a few days. So very, very liquid. It's also tangible. There's, as you say, tax advantages on coins. Yes, it's wearable. The storage and insurance costs, yes, you do have to pay them, but I think it's very important to realise that you don't have to take delivery, so you can get the people you buy it from to store and insure it for you.
Yeah.
Yes, there's a cost, but
so if it's like the Royal Mint, you just pay them to...
You just pay them
storage and insurance.
A monthly fee.
Yeah.
It's not much. I don't know what it is exactly, but it's probably not dissimilar to an annual management fee that you would pay a fund manager to store and insure it for you.
And gold ETFs, I mean, we've got lots and lots of trader friends here that look at gold ETFs and indeed buy them. This is, easy trading, low fees, no storage hassle. What are the downsides?
Well, I think gold ETFs, I think they're a very good short-term home for money. But you have to remember that there's often limitations on what you can actually redeem them for. So you redeem them as cash rather than gold. And quite often the ETF is actually backed by, well, it's derivative driven. So the uplift is in your investment is basically down to derivatives. And so if you're trying to move away from derivatives because you're concerned about the financial system, then it doesn't make much sense to invest in something which you're actually trying to move away from.
The point that I keep facing when I look at a gold ETF is you're essentially paying a middle person to gain exposure. Is that your view as well?
Yeah, I mean, some vehicles, they say, oh, we're backed by gold.
Yeah.
And, if they say, oh, we're backed by gold, my take on it would be, well, why don't you buy the gold anyway and have it, under your name rather than their name? Because then you can, you set your own rules, redemptions and things like that. And also, if there's costs to be incurred by storing and insuring it, they will have to pay it and therefore you will have to pay it. So by investing in that type of vehicle, you might dilute those fees a little bit, but personally I'd rather have the control of the gold. And while we're talking about that, another thing I like about gold is it's divisible. Compared to, let's say, a property where it probably costs, let's say, £300,000, £400,000. If you only need 20,000, you don't want to have to sell a £400,000 property to get £20,000. You can't just sell the spare bedroom. And whereas with gold, if you need £20,000, you could just sell one bar, a few coins, whatever it is. And you've got your money and you've got the rest of it still invested.
Cool. Producer Phil, how much time we've got? Because we've got loads of questions coming in. Right, Andrew McKilvey saying, and not gold that's gone up, it's the pound that's gone down because our government, and not just our government really, keeps printing money, keeps the rollers going. What's your view on that, Simon?
Andrew's absolutely spot on. It's
we talked about this earlier, didn't we?
Yeah.
It's like at every single point, whether it's great financial crisis, it's COVID or whatever, we just print money, print cash, helicopter cash, steal from the future.
Well, that's it. I mean, you know, you mentioned the bill earlier about, you know, the US printing loads of money for this wonderful bill, but that's printing money. And so gold stays the same, the dollar goes down in value. And I think that's, you know, that's incredibly valid. And one of the reasons why I like gold, because you can't print it.
And that dovetails beautifully. We didn't plan this, I promise you, to my next chart, which I wanted to show you. You have that grey line, which is the dollar, and we have that red line there, which is gold. And look at that, you know, beautiful contrast there, because really one of the things that's supporting gold, in my humble opinion, is this de-dollarization. Right, back to investing though. Some other ways, I mean, we talked about ETFs, we talked about, you know, like the iShares Physical Gold, ETC, Invesco Physical Gold as well, another popular one. But let's take a look at perhaps gold miners. You know, I have lots of people on the show that like gold miners. Andrew McKilby, big fan of Greatland Gold. You know, of course, there's the Barracks out there as well. What do you think of, you know, trading the gold miners as a way to get into gold?
I think it's great. I think, you know, you know, once you've got your physical gold and ETF or funds, whatever you like, then I use a fantasy football format to explain the companies, where a goalkeeper is a very large barrack type organisation. Then you've got defenders, which are sort of smaller but still very large companies. Midfielders are new to production, and forwards are your explorers. And obviously depending on sort of your level of risk, but you know, I think that you want to have a goalkeeper. You then want to decide how attacking or defensive you want to be. So decide how many defenders you have, how many midfielders you have, how many forwards you have. But I think by doing that, what you do is you get exposure to the sector, but from a variety of different companies. So you don't have all your money on one particular company.
All your eggs in one basket.
Exactly. And I think the other thing is a lot of gold miners, they not only are involved in gold, but they're involved in other commodities as well, where, you know, copper or silver or zinc or whatever it is. And so by having a diversified portfolio, you're also diversifying in different commodities as well.
I always say that, you know, if you are invested in gold mining stocks, you know, be aware that there is higher risk depending on where these miners are, right? And that risk comes from, you know, if it's, remember that Resolute Mining story when its executives were detained in Mali?
Yeah.
All that has an impact on the share price, which could cause very, very heightened volatility. Simon, would you say you prefer mining stocks that are, you know, in safer or relatively safer geographical, political landscapes?
Yeah, I mean, I you know, there's plenty of companies in Canada, US, and Australia. So if you're going to invest in the sector, then you can get plenty of exposure just by investing in those countries. And not only do you get the country diversification, you get the currency diversification as well. So you're not, let's say, just in sterling. You've got some Canadian dollars, US dollars, and Australian dollars, and obviously you've got commodity exposure as well. So you're diversified on a number of different levels.
We have Monkey Man coming up there saying, I like that analogy. I guess that means your football analogy. Andrew McKilby also saying Greatland Gold up over 9%. They mine in Australia.
They do.
But they also have...
I think they're in Tanzania as well.
Yeah, I feel like there is a...
Yeah, it's there. I think they're in Telfer in Australia. But yeah, I mean, it's... If you've got a company which is in Australia, Canada, or the US, then, you know, I like it.
Yeah, I am bullish on Greatland Gold, and they've been doing very fine things. Thank you very much. Andrew was the one that highlighted Greatland Gold to me in the first place.
9% today. Pretty good.
Julian's message there, am I correct in thinking you don't just print money, you have to borrow it into existence?
Well, yeah, I mean, but if you're a government, then you own the credit card.
Yes.
And so, you know, you don't have a limit. You just print as much money as you want.
Yeah.
I think that's the rub.
There we go. Andrew McKell was saying, correct, Telfer. There we are. Yes, and that's a run with the governments as well. And that is why we're in that sticky mess that we're in right now. You know, and we're seeing the bond vigilantes as well. Very quickly, digital gold. Pros, fractional buying, convenience, but the downside, fees and no physical possession. Do you like digital gold?
I prefer physical gold. You know, I think that digital gold is a combination of crypto and gold.
Yeah.
And I think if you want crypto, you buy crypto. If you want gold, you buy gold. And I wouldn't want to have a product that kind of has both. I'd buy either or.
Let's just have a look at, you know, some of the digital gold providers. There are quite a few earlier. This is a trusted name. You know, you got that. Simon talked about the secure storage option as well. But, you know, I guess I want to end with, you know, what is your preferred method? Given we have different durations there, different traders with different durations there. Give us a short-term play. So, for example, you know, this week or next week. Or if you have a medium-term way, if someone said, I want to be in the market for 3 to 5 years, and a longer-term way to get in.
Yeah, I mean, I would say short-term, I would probably say, I know, within 12 months. No harm in having ETF if you've got a very short-term view. A lot depends on how much of your money you're putting in, obviously. More of a medium to long term, I'd say physical gold.
Is this 3 to 5 years?
Yeah, 3 to 5. Yeah, well, I'd say medium term, 1 to 5 years. I'd have physical gold, and over the medium term, I'd also, you know, look at companies. A lot depends on where you are on the risk profile, but yeah, I think that you know, physical gold, I love it because it's so liquid, and you know, if you want to sell it, bang.
Yeah.
You sell it now.
And you can sell it in chunks as well.
Exactly. You know, and you know, if there's a market crash, that's obviously going to affect your equities, could affect ETFs depending on what's in them. But if you've got physical gold, you know, it's an asset class in itself.
R6 Senna coming online with a question for you on that.
Where can we buy physical gold? Well, I mean, I buy mine from the Pure Gold Company. There are plenty of places. I think all I'd say is you want to do due diligence. We've mentioned the Royal Mint. You can buy gold from Royal Mint. You can buy places like Bullion by Post. And a lot depends on how much you want to buy. You know, because you know, if you just want to buy a couple of coins and something like Bullion by Post, even though it says by post, you don't have to get it posted to you. You can, you know, you can buy it and store it. If you want to buy a bit more, you know, Pure Gold Company I like, and then you've got people like Degussa, yeah, there's lots of places, but make sure that they are do your due diligence. Make sure they're bona fide. Make sure they've got. I mean, the company I use are affiliated to the LBMA, and they're a distributor for the Royal Mint, and so yeah, you want to make sure that they fit the profile you're looking for.
Right, we have to leave it there, but any more questions, see loads more coming through, whack them in the ask@ig.com and I'll get them in front of Simon. Those emails come through to me. Like and subscribe if you find this useful, because we are trying to get to how many this week, Producer Phil? 1,000 this week. Here we are. He was busy putting that animation up. And also, please do, you can find Simon on his LinkedIn as well. So if you want to ask him questions over there. Simon, have you liked and subscribed?
Yep.
Well done, yay! R. Saxon, everyone on the chat saying thank you, guys. Right, we'll see you tomorrow. Bright-eyed, bushy-tailed, happy hunting, and good. Maybe see you on Discord.
Stocks keep drifting higher. No news, light volume. It's Tuesday, June 10th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, as we're here to take you through the rest of this trading hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, if you're here on the website, tastylive.com, thank you for joining us. If you're over on YouTube, or come over to YouTube, tell us what you're trading, what you think of this action. As Victor might say, smash the like, spoof the algo, whatever you got to do to get more audience here is apparently the edict. So we are here to talk markets, guys, and it's a day where it's pretty quiet out there. We only crossed 1 million contracts traded here in ES by the end of the session, barely 1.01 million contracts traded. It is a slight gain of 0.5% here in the NASDAQ, a little bit more than that actually, 0.57%. Weakish, sloppy 3-year note auction doesn't really do much for the bond market. Bonds inch up across the curve, but not by much. Gold and silver take a step back, as our notable metals bear Radigan points out at the end of last call. Dump the metals apparently as a theme for today, although not terribly. We see that oil reverses here after being higher over the course of the session, does come back in. And likewise, that dollar, it is a touch firmer here on the day. Tomorrow we have the inflation report due out. Maybe that's what this market's waiting for, or more signs from the U.S.-China trade talks in London, which are still ongoing. They have resumed those talks after dinner. So we have a lot to discuss here today. Dylan, you are apparently a bull's bull again. Welcome. 60-45 here in ES.
I call this the full bull.
What makes you the full bull here, and what has changed your mind?
I believe all of the Trumpian fears, whether it's the legislation or the tariffs, is irrelevant and unlikely to occur. I think all the social stuff is a distraction, and I believe that Trump is actually rapidly becoming a very weak president. And I believe that not only is AI more powerful than anybody can comprehend, but I also believe transportation technology is more powerful than anybody can comprehend. And I believe that the overall economy is shockingly resilient relative to all sorts of adversity. Makes me want to own the bond, which I bought today. Makes me want to be short gold and silver, which I did today. And makes me want to be long the dollar, which I did today. I was more active today than I've been in some time, and I'm full bull. And that's all that's all I have to say for myself.
By the way, if you want a wonderful contrarian indicator to support Dylan's case, the fact that these protests in LA are burning Waymos is a great statement as to the wonderful future of transportation technology.
Yeah, there you go.
If you wanted the Economist cover level indicator for here is a company that's going to do well and here's a sector that's going to do well, that nutcases are burning Waymos, very encouraging.
And everybody's so jacked up on AI that no one's talking about transportation tech at the same level. I believe that the transportation technology discussion should be as fervent and insane as the AI conversation already is and has been for a couple years now anyway. And I think that it's underestimated in terms of its impact, in terms of the velocity of the economy. And I just think it's another huge tech vertical that is underrepresented. And it's one thing to have one pillar of glory with AI, but if you add a second pillar of glory and you add a rapidly weakening president who's going to have a hell of a time implementing any policy very quickly here, I love the dollar. I like the bond, and I think metals are overvalued.
Ilya, you know what?
Kind of a testament to what we talked about yesterday. This idea that there's loud gridlock afoot. And even though it's loud,
more and more room for it.
Yeah, that even though it's loud, the markets do like gridlock.
What's really interesting about what's happening in California, just from like an anecdata perspective, and talking to even political-minded folk, like, oh, what do you see the protests? You see what's going on? Marines being deployed.
Yeah,
I would say 4 out of 5 times I've had that conversation in the past few days. The first remark is, we have self-driving cars.
It's a symbol. It's become a symbol.
Well, no, but it's kind of
that's really important.
I think it's like, it's kind of I mean, we're all online. Like, we're all on Reddit. You're on Twitter. Like, where are you seeing the technological edge discussed amongst people. GitHub, right? Like where new code being posted, right? Like we're in the thick of it. So when AI comes out and there's a new Chat GPT model, we're talking about it because it's the most liked thing in our feeds because Sam Altman or, the OpenAI account put something out. But for the average, for like the regular person, we're talking about Tesla cabs and Optimus and, robots.
I mean, and Ilya sees it all the time in San Francisco. I go to California, 3 or 4 times a year. If you haven't seen them, you don't understand, but they exist and they're everywhere. And
San Francisco is crawling
and Tesla's face deep in $1 bajillion million on this. Google's face deep in $1 bajillion million on this. The transportation, and it's not just the cab fleet or something. We're talking about transportation tech ranging from the entire logistics chain. Even just the efficiency of how they pack trucks and how they position trucks and all the container ports and the port technology. Remember, we saw this whole thing with the ports with Biden. That's going to change. The ports will change in a way that is much more efficient and much more productive. And trucks, all these things, it's going to happen. And it's one of those things where nothing happens. But when it does happen, it happens so much faster. It doesn't happen incrementally. It's just, I love to tell this story, but when I was having been on the floor of the New York Stock Exchange for years prior to digital markets, basically, and then listening to the speeches to the floor trade. Oh, well, we're going to do this hybrid system, and it'll be a slow transition, and all the blah blah blah. And then the day finally came. I don't remember what year it was, but the day finally came where they flipped the switch. And I swear, I think that very first Monday morning, something like 80% of the volume traded off the floor immediately. And I just think that the same thing's going to happen with transportation tech, in a way that is profound.
Ilya, it kind of surprised me. I was looking at this earlier. We have images of Waymos burning on the street, of course, which is most closely associated with Google here. Google, outside of, Google and Tesla are your top 2 performing Mag 7 names this week thus far. Social political commentary, aside from what's happening in Los Angeles, I'm kind of taken aback that some of the first reactions I'm hearing, and most of the time, right, I'm saying 4 out of 5 times, people are saying, wait, so these protesters, very dumb, obviously, you're getting on your phone where you have an account with your name and credit card attached to it to call a Waymo to a protest for you to burn? Come on, use your head, folks. But if that's what they're doing, hold on a second. You can call a self-driving car to come pick you up and take you anywhere.
What a demonstration of the technology, and what a demonstration of how in the zeitgeist Waymo is, that crazy people are attacking it.
I would argue more people became aware of self-driving cars over the last,
That's my
4
point.
days.
Yeah.
Than the totality of the incremental awareness that had been accrued over the last 5 years.
That's kind of what I'm getting at here, right? Looking for...
People hadn't seen it. Now they see it.
All right, so we're always trying to find silver linings in dark clouds. Perhaps an interesting...
The rest of us are trying to find dark linings in silver clouds, but go on.
There's plenty of dark linings for you here. What's interesting about the iDrive ETF, this isn't like a typical, you'd have to break this down, but the iDrive ETF has BYD in it. It has a lot of Chinese names in it. It's Rivian, there's Porsche, there's Renault, there's Volkswagen, and it's been basing for a long time here. And there's just this little voice in the back of my head saying, if we're going to see this in the news all the time, maybe we should be considering the fact that this seems to be a pretty darn good advertisement for the self-driving vehicle class. Aptiv, which is another company that works in the space, which would be in the iDrive ETF, 4.75% higher today on the back of all this. We could head over to a name like Rivian. It's bounced a little bit this week. We can go over to something like Renault. The performance has been mixed here, depending upon, actually, that's not going to load, depending upon where you look. We're not going to get these tickers. We're not going to get these tickers. Well, the point is, let's just look at the broader ETF. We're approaching the top side of the yearly range, and we spend so much time talking about AI around here that self-driving vehicles have been overlooked, and it feels like a bubble was just popped in the past few sessions in terms of breaching the public zeitgeist. The iDrive ETF is up 2.94% this week for what it's worth. SPY is up 0.66%. Triple Qs are up 0.81%. Semiconductors up 3.7%. So like not many things are outperforming it right now in the broader market. And I don't know, it feels like an interesting way to discuss what's happening here. It feels like there's new technology being showcased that a lot of America hasn't been exposed to yet, even if they've heard about it perhaps in a tweet or a Wire.com article, which most Americans probably aren't reading. Dylan.
And I believe, and Elon's return to Tesla, despite all of the awful things and all of the terrible things and all the screwed up things, he was going to return with a vengeance. And the first threshold of excess performance is a fleet of self-driving cars that will lay up, and for that matter, self-driving trucks. I'm talking big trucks that can do coast to coast. And anyway, yes, I like the sector as an investment for the reasons we're describing, but also I believe it's a pillar of economic activity that is underestimated right now in a world that's obsessed with what they perceive to be the sort of the AI core. Of all the names that we know. I won't repeat all the AI names, but I just think that people are underestimating how powerful and significant this is, and I think that the burning of the Waymos is the best thing that ever happened to them.
Ilya, if only to put like a finer point on that, I would pull up the Google Trends chart here for self-driving car. And right now, according to this, over the past year, we're looking back, we have hit what would be considered the 100th percentile on the search term over the past year. So, like, this is why this intrigues me. I was going through this exercise actually with Jamal today about the word tariff. The word tariff in search terms is in the 5th percentile over the past 90 days. And in news terms, it's in the 7th percentile over the past 90 days. It's basically a non-factor in people's attention right now. But then you swing over and I start looking at some of the keywords in the news recently, and I go, self-driving cars are being picked up a lot. And I've heard this own feedback in my own personal life. Like, did you know that there were self-driving cars? Like, yeah, you didn't? No, I had no idea. Oh, okay. Well, sure enough, the interest is there, and there's a bunch of junk in some of these, in iDrive, but like a name like this, Gentex Core, what do? They make auto parts related to electric vehicles. They were up 2.87% today. A lot of weird things rallied today, even though it wasn't a significant move in this market, broadly speaking, the indexes. But there did seem to be a little bit of a theme here starting to emerge. And I think, Dylan, maybe this is a theme that we should be keeping an eye on moving forward. Just a different way of approaching the weekend.
The only question is for me, it is without doubt or question. I think the only question is what mechanically is the most sort of prudent, risk-adjusted, non-madman's way, the prudent man's trade to get long something that's basically a certainty. It is. Their self-driving cars are here. They're going to be everywhere. It's going to happen. The only thing that's discounting price at all is timing. And so it's just a matter of understanding the most prudent way to get long from a trading perspective, outside of just sticking the iDrive or one of these companies in your sort of investment portfolio and saving yourself the trouble.
Yeah, I mean that self-driving cars are a fait accompli is that. I mean that's there already. They're already so ubiquitous in the streets of San Francisco that it is just a matter of scale now. The fact that they are able to operate seamlessly in a city that's dense and full of traffic and full of people and buses and all manner of other things, because San Francisco is not LA, San Francisco is dense. That's already on display here, clearly. To do this to trucking would be easier because that's in many ways a straight line. To do this in other cities becomes a matter of scaling, but the proof of concept is obvious. The thing that interests me from a trading perspective versus an investment perspective is, do you buy this now with a 45 DTE type of cycle in mind, or even longer? I've been doing 60 lately just to kind of keep my risk a little bit more contained in these choppy markets. But let's say even that. Is that a story for that kind of a cycle? Or to Dylan's point, is it a story for eventually this becomes a thing, you know that's going to happen, stick it unlevered into a portfolio and forget about it for the next 10 years, other than buy more when there is a spot to do it? And if it's the latter view, then you probably wait to clear this most recent high, and then you just buy the ETF, call it a day. And the next time it dips, you do that again. If it's more the trading sort of view on this, then your risk reward is probably not ideal because you're near that high.
Mm-hmm.
And so then you're sort of waiting to see, do you break the high for a breakout trade? Do you get a pullback because of generalized risk aversion? Because let's say, and I'm not saying this is going to happen, but here's a sort of simple scenario. CPI comes out and there's a bunch of tariff-related inflation in it this time. It isn't hidden in the PPI numbers this time, as we found out for April. Once the PPI numbers came out, we saw, oh, CPI was refreshingly normal. And then we see the PPI numbers and go, oh, it's refreshingly normal because businesses ate the inflation and didn't pass it on to consumers. It's not like the inflation isn't there. It is. It just ended up being in businesses' margins. So let's say this time that doesn't happen. But as, let's say, the PMIs suggest. Let's say this time they passed it on. And you see it in the inflation numbers. And you see it in the inflation numbers despite the fact that the economy is slowing and the Fed wants nothing to do with a rate cut, at least until September. Okay, now what? You get generalized risk off, maybe, that sinks everything. Regardless of sector, regardless of theme, regardless of whatever. And then maybe you get a better risk reward setup in these things as a trading vehicle. As an investment vehicle, if you want to not be time sensitive and not be tethered to options expiries and be unlevered and just stick it in a portfolio, I don't see why not.
Yeah, there's not many tradable liquid products within there. And if you're going away from the broader sector, you got to pick and choose winners, which I think is worth an exercise of reviewing. I'm personally going to be spending the time in that. I like to put together small thematic baskets that I trade and just put in my pocket. One of which is kind of working out, I guess, with a AI Phase 2 basket that I've been tracking in this year since late January. I mean, it's up 2.9% year to date. 3.03% year to date, which is a little bit better than SPY's 2.9% year to date gain, but it's below the NASDAQ of 4.5%. So it could be a function of stock selection, not necessarily the theme being wrong. But I like thematic baskets, and I think they're, it gives us something to talk about and follow. And more importantly, it's now in people's attention span, which not just Anecdata, Google Trends, highest interest that we've seen over the past year for self-driving cars and robotics, obviously. There's a guy named Brett Adcock on Twitter. He runs one of these robotics firms, and he posts videos of what his robots are doing all day long. Really fascinating stuff. So when Musk says that they're coming sooner than later, that's something I think we can believe in. But Dylan, you mentioned being a bull.
My only question, I know we've got to move on, we're sort of grinding on this, and I apologize. But my only question is, why wouldn't you just buy Tesla? Like, why overthink it?
It's a really good point. Mags are up at the, highest levels that we've seen since the February 21st growth scare, LAS. Mm-hmm. Yeah, just on price. I mean, Tesla's there driving this higher too. It had a big reversal intraday yesterday where it was down like 3-4% and closes 5% higher. Today it has now a 6% gain, basically 5.67% in the bag. Ilya, I know that doesn't look like Trump and Musk are getting back together anytime soon, but Musk's feed, if you went into a coma on Thursday at 12:45 p.m. Eastern Time, before Musk tweeted out such ingratitude at 12:46 p.m. Eastern Time, and you woke up today and you only looked at the tweets from Sunday, Monday, Tuesday, you wouldn't know that Trump and Musk were on the outs.
Not necessarily, no. Of course, everybody is writing about it, but with the stuff going on in LA, it's already dropped out of the kind of big headlines, and you really wouldn't know. But again, for me,
hold on a second. So the public perception is that Trump and Musk have a really big fight. The LA things start. Trump and Musk, if you're following it closely, seem to be making amends, but the broader public only knows about the fight and now about the riots. So the average person thinks that Trump and Musk are on the outs when they're really not.
I mean, well, whether that they are or they're not,
they're not on the outs.
The president doesn't seem to want to engage with anything, and Musk seems to have been talked down by cooler heads to say, look, you have a bunch of federal contracts, don't bite the hand that feeds you quite so loudly.
And that doesn't come across as odd to you that both of these men are acting completely out of character? Right.
I mean, it strikes me that the president understands that he doesn't need to do anything for this to go away. And it strikes me that Elon Musk has been made to understand that he does not need to be screaming publicly right now. And that this does not benefit him for whatever future endeavor he wants to make into politics. That he basically needs to rebuild his war chest here. And he can't do that if he loses the money-making machine. So it seems like we have a kind of détente. And that's fine. For me, as far as sort of the logic to buy Tesla as a trade vehicle, it's the same story as you would see in NASDAQ, in S&P. We've backed up into the underside of the preceding range, so we're testing near-term resistance. Let's see a break. Or a pullback. Either or, by the way. You pull back to 300-ish, you've reset risk-reward, it makes sense to go long. You break north of, let's call it 370, you've reset the range. You have clearance. For a trade, for an investment is a different conversation. For an investment, this is a big discount in Tesla. If you're going to own it for the next XYZ years, I don't see a reason not to buy it here. Certainly the Trump-Musk fight is not a reason not to buy Tesla.
No, not a reason not to buy Tesla. Again, one of those pieces of anecdata after the Trump-Musk fight this weekend, talking with people joking like, oh, it's safe to buy a Tesla again? Thank God.
Whoever was going to get a cheap Tesla while they were on the receiving end of the blowback, now apparently it's Waymo. Look, it's moved.
Well, until Tesla's self-driving cars are in Austin, but...
now Waymo is going to have to put stickers on their thing saying, we don't endorse XYZ, whatever.
Dylan, I mean, I think it's just right. I mean, Tesla's got robotics. It's got the AI. It's got the cars. Change happens faster than people appreciate. Right? So...
yeah, well, it's nothing, and then it's everything.
And it's everything.
Or at least
nothing matters until it all matters.
Yeah.
Well, I mean, we're reaching that tipping point. I think everyone can kind of feel that it's coming, and I know for people who are in like information services roles like we are, AI is something that's becoming an increasing part of our day-to-day use. At least for me, it is. I use it every single day, professionally, personally, for various tasks and things. Some of it automated to do stuff for me. Some of it to find information. But I think it's a way to augment, like for what we're doing, it helps augment and cut corners. You know how great it is to be able to feed, my little Chris GPT a spreadsheet and say, like, tell me what this says, as opposed to me having to, like, even have to feed a bunch of things into Python or like our Jupyter platform here and run a bunch of code. I just give it a spreadsheet and go, tell me what this says. and it knows all the algos and the formulas and all the data analysis that I would do because I programmed it to do that. And it just saves me hours of time every single day. So I think that's the way you have to use this in the world moving forward to augment whatever you're going to do, because the change is coming. And it seems to be coming pretty fast. It seems to be coming pretty fast here, folks. We're halfway through the show. Today was a pretty good rally. I know people like Goldman Sachs are out there saying that start selling the junk rally, although I would point out that this is a market here, in the short term, that is seeing increased breadth, the sort of broadening out right now of the rally. QQEW, equal weighted NASDAQ, is up by 0.79% today compared to the 0.66% gain for your market cap weighted NASDAQ. Same thing for the S&P 500, of course, up by 0.52% in RSP. We head over to SPY. It's slightly different. Actually, they flipped now here, 0.55%. I stand corrected. Most of the session, the equal weights were leading the market cap weights. But you're seeing the equal weights, I suppose, which is the point of this. They're pushing to relative highs right now. RSP is getting up there. QQEW is starting to get up there. This is a market with broad participation. So, Ilya, I pose this to you as the bears bear around here. We have low volume. We have low volatility. We have a market that seems either very complacent or very confident that nothing will ever happen that's materially negative to the equity market outlook. We have a Fed meeting next week, expiration, June options expiry, of course, quarterly option expiry at the end of the month. We have the July deadline for these tariffs. How is a bear handling this right now? Like, how do you try to keep powder dry, or do you load the boat now saying it's as cheap as it can get to get bearish? I have to take a swing here because this thing is weaker than it looks.
I mean, I certainly am of the view that this thing is weaker than it looks, but then you have to approach that point of view tactically. I've been sitting on the short side in a risk-defined vertical in both the Qs and in SPY now for quite some time. In fact, I'll give you the exact dates. I've been sitting in the Qs now for about almost 40 odd days, and I still have tons of duration, tons of it. On some of the contracts, still 38 days worth. So for me, it's you take a stab, you take a risk-defined, extended duration stab in the ETFs, which are smaller than the futures, and you see, because you have to be really insulated against the market wanting to fight you. So for me, this isn't anything I have a tremendous amount of additional conviction in now versus when I put these things on. It is notable, I think, if you look at either ES or NQ, where we end up here today on the eve of CPI, and I think in ES is probably where it's most profound, because actually it made a better run through its near-term highs, arguably. It made a cleaner break.
Sure.
But look at the underside of the consolidation range before the holy hell begins in February. And look at just the open on that green abandoned bar right there at the bottom of the range. So the lowest open in that series. A little bit lower. Basically right, yeah, exactly, right there. You've closed on it. You've stopped directly on where the consolidation became a sell-off. So this is a very interesting spot. I'm perfectly happy, by the way, to let my puts expire worthless, because I structured them such that they could do that. That's sort of the benefit of cheaper vol and smaller size and long duration, to keep your loss small in the worst case scenario, because you're fighting a market that doesn't want to go your way. This is sort of the beauty of options. So we'll see. But for me, this hasn't sold me on the idea that the premise that brought this market down at the beginning of the year has changed, because it hasn't. The premise was slowing growth. And then that was hijacked by all kinds of noise. Well, we've gone through the full sentiment gamut on the noise. We went from, oh my God, the US-led financial order is being imploded from within, now to none of any of it matters. But at the end of the day, it's neither of those things. Of course it matters. And it matters not because we're going to implode the US-led financial system. It matters because businesses and consumers need a semblance of policy certainty to make decisions. And without it, there is not economic growth.
Dylan, can I challenge Ilya on some dark grounds?
Yes.
Be my guest.
What if the stock market's increasingly becoming a game that is increasingly detached from the real economy?
It's very possible.
Right?
It's very possible. We heard Moody's warn today of the...
Moody's. One of our prestigious rating agencies. Go on.
Yes. They warned today. This is how you know this is right on time. They warned today about money managers and institutions chasing retail speculation.
Yes. Well, they had to. Quarter's coming to an end soon.
Wow.
They sold out in early April.
Perfect.
Knew it was coming.
Perfect. It's perfect. Which tells you you've maybe reached maximum on the froth. And whether you have or not, who knows? You were mentioning, I think, right on time, that speculative short positioning in the latest COT report has been nearly wiped out, and that's as of Tuesday of last week. Now, when we get the report this week, it'll be as of Tuesday this week, and looking at the markets here, chances are there isn't much short positioning left, which is a pretty good recipe for a rug pull. And for me, that rug pull is very simple. If the inflation data, both tomorrow and the PPI numbers thereafter, tell you that consumers aren't coming despite businesses having stocked up and spent all this money on extra inventory and eaten the extra price margins, then there is no way to avoid a recession, and the Fed doesn't care and won't care until it's so obvious to everybody, much as self-driving cars in San Francisco, that it's too late. And by then, markets will have anticipated already. And if you look at the break-evens in the bond market that are telling you that a recession is coming, which were moving in lockstep with the S&P from the beginning of the year until the bottom in April, and then pointedly decoupled, stocks rebounded, break-evens didn't. Break-evens are telling you you're no better off. That tells you stocks are frothy, probably, and driven by sentiment, probably, and decoupled from the economy, as you're saying, probably. With all of that, you're waiting for a breaking point. Does it come tomorrow? I don't know. But as long as I'm structuring my exposure in a way that's risk defined, where I can take a loss equivalent to this thing expiring worthless, and that doesn't debilitate the account, that isn't anything to look at other than, oh, well, that's a trade that didn't work. The short dollar trade did. La-di-da. On we go. Then I'm happy to sit in it. It comes down to risk management, ultimately.
So we have China trade talks perhaps guiding the market higher here today on some optimism. There was a rumor this morning that the trade talks ended early, but no, of course, just like what we heard in Geneva, that was actually fake news. They were ongoing and they were just taking a break for a meal because they're people and they need to eat.
Is it safe to just assume that whatever headline comes out, the opposite is true at this point?
Yeah, like they're not ending, like U.S.-China trade talks end at 1 p.m. exactly on the dot in London. Okay. And then they're back on an hour later after lunch. Got it. So that was the case again today. They ended, they took a break, they were meeting again after dinner. They're still going on right now. From my view, that's probably a good thing. The longer the talks go on, the more that they're discussing. They're going into the weeds. They're really, delving into the details. So that might be a buy the rumor, sell the news event this week. But before we get there, we don't know if that's going to come today, tomorrow. We know that Carolyn Leavitt, the White House press secretary, said the goal is to leave the meeting with a handshake agreement. So they're not there yet. Inflation data is due tomorrow morning. There's part of me that says this is important. It's inflation data. Inflation data always matters.
Yes.
There's another part of me says that this doesn't matter a lot. So, Dylan, I'm going to make the case that this doesn't matter. One of you two has to convince me otherwise. I'm going to go to the options pricing here first.
Start the clock. 60 seconds on the clock. Why the inflation data doesn't matter.
Fed's not priced for a cut next week. 3% chance. They're not priced remotely close for a cut in July. We're going to get a new summary of economic projections that, if we look to the inflation data that's here and coming down the pipeline, we're probably looking at a modest bump in headline inflation the next few months as we make our way through a base effect window. So inflation this week is expected to rise. We're going to look at from 2.3 to 2.5%, and the June tracking thus far through the Cleveland Fed is basically 2.7. So we're not going to get a cut. We know that. We're not going to get a hike either. We know that. The Fed's told us they're more concerned with growth. The market's only priced 43 points through the end of the day tomorrow. That's accounting for 3 as well through the end of this session. So 40 points, less than 1%. We're at 6,000 now. We're talking about 2/3 of 1%. That's a nothing day being priced in. It doesn't impact the Fed. I don't think we care. I don't think the market cares. I don't think we should care. A 0.2% month-over-month run rate is fully in line with the 2% year-over-year target. The Fed is not going to blink, neither should we.
Shall I?
Go for it.
Well, hang on. Before you do...
You said a minute, so I kept it to a minute.
I would just like to layer that beautiful and glorious piece of lumber that my friend Chris Vecchio just chopped down and laid across the road as yet another reason why your good friend and neighbor over here on this side of the screen is full bull, my friends. Long the bond, short gold, short silver, long the dollar. Because not only are there multiple pillars of super growth hiding in plain sight, but inflation is a non-issue, as my good friend Dr. Vecchio said. And now I shall hold my tongue so that you can say what you must, my California-based friend.
I won't argue with anything Chris has said, because everything he has said is correct. It is also fully priced in and has been fully priced in for a very long time. That is not a premise to not care. That is a premise to say, okay, well, here's the baseline. Now, what's the likelihood that we get something shocking off the baseline? And an indicator that Chris and I like to watch is the interplay between the ISM services component of the component of inflation in those numbers, because over the past decade, they've tended to front run CPI and PCE by about 2 months. That reading came back as the highest since November of 2022 in the most recent report, despite the fact that the overall service sector shrank. So it didn't come from growth. That would be right around now that this should show up. And it would keep the Fed on the sidelines, even if it doesn't show up this month. But the question isn't, will the Fed be or not on the sidelines? Because that's priced in. The question is, does the market want the Fed on the sidelines? And is the market happy with that idea? and looking at the break-even rates, the answer is no. Because as we've started to see rate cuts get pushed into the long bond, stocks have pointedly capped their rally and transitioned into whatever this slow, low volume drift thing is. And so for me, the revelation isn't going to be that, oh, the Fed doesn't have to cut. No, we know that already. The question is, what does the market do with that when it knows what it knows about growth? When it gets the confirmation from hard data.
What if the hard data never rolls over? The soft data is starting to normalize a little bit. People are getting a little bit less worried about inflation, a little bit more confident about their finances.
Where?
People are less concerned than they were. We just saw the single
that's not what the University of Michigan.
Haven't you heard, Ilya? That's what the people say. That's people, man.
People are saying.
People are saying,
man.
They're not saying it to the University of Michigan, I tell you what, because they just released their consumer confidence numbers, and they were terrible again. Now, they were a little bit anchoring at these low levels. They hit a 3-year low in April, and they didn't get off that 3-year low, but they also didn't go lower than it. The conference board numbers are for April, and they were still awful, just less awful.
Conference board was bad in April, but then it jumped by 12.3 points in May, and its largest single month increase in 4 years.
Yeah, but look at where it's sitting.
Just below. So conference board is like a PMI in the sense that 100 is their break even.
Yeah.
But like present situation index is at 135.9. That's well above the neutral rate.
No, but that's normal. Look at where the overall conference board index is, because
but this is the difference. People are saying things are fine right now. We expect them to get worse. Right? That's what's driving consumer confidence lower. It's not that things are terrible
your
today.
Own screen here.
Yeah.
The expectations index remained below the threshold of 80, which typically signals recession ahead.
No, I get
there.
I got that, but if you make another surge like this in the next month where you're continuing to normalize because the tariffs are in the background and the pause is ongoing, then you're out of risk. But we've done that. Tariffs are not being discussed. Everyone's waiting for them to fall.
But that's not what. Again, we just got the updated University of Michigan numbers. We're going to get them again this week, by the way. So we'll get a sense. But the expectation for May is an expectation. We'll see, but there's no evidence to suggest that consumer sentiment is recovering. The evidence for now seems to point the other way. Now, maybe these May consumer confidence numbers on Friday tell us something different. I'm certainly open-minded to seeing it if it happens. But it hasn't yet. What we've seen so far is that businesses have been stocking up inventory that nobody is coming to buy. We've seen that in April, even as businesses were front-running the tariffs, consumers opted not to, even though they had more of an impetus to do that after Liberation Day and then the 90-day pause. They did not, though in March they did. We see that in the sort of GDP math here, already in the first quarter, that's led to a significant decline in consumption. And if April retail sales were telling, then not only did consumers not come out, despite the fact that there was a reason to front run, they didn't come out despite the fact that businesses ate the extra costs for them, as we learned in both CPI and PPI numbers. That certainly looks like hard data to me. The question for me isn't that the economy is or isn't significantly slower. It is. The question is, when do markets care about it? And how much weakness do you need to see before inaction at the Fed scares you? And the price action since about May the 29th, let's say, maybe even earlier, the 22nd, suggests the caring has commenced, albeit very cautiously. And if you get a CPI number here that's spicy, and the expectation is 2.9 on core, that'll be a 3-month high. Then you're getting to a place where things might get spicy. Not because the markets know the Fed isn't going to cut. They know. It's because the fact that the Fed is not going to cut becomes a thing to fear.
Well, I think tactically, that's kind of where my head's at the past 2 days. For those who've been listening to Futures Power Hour and Overtime yesterday, we have the Fed meeting next week, VIX expiration, options expiration for June. July has been the best month of the year for stocks over the past decade. You haven't seen a red July for the NASDAQ in over 10 years. Over the past 20 years, it's up 85% of the time in July. So it's hard to justify, with that seasonality in front of me for me getting too bared up. But you get through the expiration, you get through the options expiration, you're getting through your Fed meeting, and then you're at the end of the second quarter. And all the people who were the heroes and bought the dip in April, they can take some profit and pat themselves on the back that they did well for their clients. Everyone else, most people still need to chase, as we've learned. But the table then resets in July. New quarter, new quarterly performance that you can try to, make up for last one. More importantly, we're going to have potential rebalancing effects in indexes. And then I think you go into a period where, hey, you get through the July Fed meeting and if there's no cut there, we are on our own for the month of August. We're not going to get anything out of Congress, maybe a deal perhaps on a bill, but typically Congress goes to recess leading into Labor Day. You're going to have a Fed at Jackson Hole. The calendar gets really short all of a sudden through the summer, where if you're a market watcher or participant, you say, geez, like if they don't give us a cut by, in the next 6 weeks, we're probably not getting one for the next 3 months at the earliest. It's a little bit of a different conversation moving forward if stuff starts to hit the fan. And then, of course, we haven't even mentioned the tariffs, but no one's talking tariffs here. Dylan, I have one thing I want to talk about before the show ends, but before we go there, what do you think is the most interesting piece of news event unfolding around the world right now? And it could be because the market's not reacting to it, and it should be, or because it's clearly driving the market.
I mean, now you kind of put me in a bad spot because I started the show with what I think the biggest news item is, which is the burning Waymos. Okay. So I saw it, but I don't want to just sort of spend the last 10 minutes on what I spent the first 10 minutes on. So I'm going to say the biggest news item in the world is transportation. The biggest relevant news item on earth right now is transportation tech and the icon of burning Waymos. Set that aside. The unspoken piece of all this, and you touched on it for a second with the potential detachment of the equity market from the so-called real economy. If you presume that most of the most valuable equity in most of the most valuable enterprises is tech or tech-related equity that's tied to some derivative of AI or transportation tech, travel tech, fintech, med tech, blah, blah, blah. The unifying thesis of all of that equity is that it's more profitable than ever because it requires less and less of the traditional labor pool. And so you have a business, a domain of businesses and trillions of dollars in equity, all of which is generating huge margins and huge revenue, but in the process, not the job creation engine that a normal boom like a previous industrial revolution would represent, which only further fuels the underlying social unrest that is the single greatest risk to world stability and peace. And it's the reason why you have Donald Trump as a president. The reason you have all the alienation, the reason you have all the political extremism is because the equity value of enterprise is increasingly tied to remarkably efficient infinitely scalable, highly productive systems that do not employ people as they once did. And so that's why the stock market can go cuckoo bananas and yet not represent the so-called real economy, which then fuels the political extremism, whether it's deep left or deep right. And that's the single greatest risk to all of us. And it's ultimately going to become a wake-up call, which is that to have an economy that works for the benefit of shareholders only works if the shareholders' interest is aligned with the interest of humanity. If shareholders' interest is benefited at the expense of humanity, it will yield catastrophic results, the likes of which we're only seeing very marginal edging of activity around that right now, with, again, the Bernie Sanders candidacy a while back, the first Trump presidency, the sort of what I think the sort of manipulation of the Democrats to install Biden to avoid any real sort of change from a more viable candidate, whether it was a younger person like Buttigieg or a more extreme person like Sanders, or the fact that the Democrats then tried to rig it a second time by just jacking everybody with somebody who wasn't even voted for, who wasn't even in a primary, and just tried to install them. All of that is very fearful defensive behavior, trying to avoid the elephant in the room, which is that the social component and the political component is vastly underqualified and unprepared and ignorant as it relates to the profound rate of change and incredible intelligence, both among the individuals, both the executive, the management of these companies, smart or extremely smart, organized or extremely well organized, the investors in these companies, smart or very smart, organized or very well organized, and the enterprises themselves, prosperous or extremely prosperous. And the political and social infrastructure is no match for it. And it is the underlying reason why the totality of the political system is in this sort of the throes of wild and extreme and idiotic behavior, whether it's fearful protection of power by the Democrats or reckless sort of, tossing around of idiotic policy by the current Republican administration. All is just a reflection of a group of people in the political and social class that are profoundly outmatched by a technological and investor infrastructure that is not aligned with the interests of society.
Ilya, same question goes to you. We've talked recession, Fed, we've talked self-driving cars here. Surely there's something that we're missing that actually matters to this market.
In my mind, what matters to this market continues to be incredibly simple. It's just the market has a varied reaction function. And what, for us as traders, becomes the challenge is to be right at the right time. And I think it's entirely logical that if the premise of the sell-off had been solely the administration is going to engineer some sort of a financial disaster because it is going to forcibly amputate the U.S. out of the global financial system, which would be a disaster on just such incredible proportion that it would be sort of like if the foundation of your house decided to build itself a tunnel and leave the rest of the house and say, well, y'all figure it out. If the premise was, oh, good, that's not going to happen, well, then this rally makes a ton of sense. And we know the market gets emotional about things like this. We saw them get emotional about it in April. There was a level of panic that was obviously elevated around the idea that the worst has occurred. You can't beat the U.S. from without. The only way the U.S. implodes is from within, and now somebody is going to do it. But that was never the logic. That was the amplifying factor. The logic was that the economy is slowing and the Fed won't do anything about it, and there is no one at the administration level that cares. So fiscal authorities are not going to U-turn. That continues to be, in my mind, the most important thing that's going on. Because none of that has become any better, but sentiment has improved. So, for me, it's sentiment neutralized in early December when they said, well, let's see what they do now. Okay, we're back in that range. Let's see. But none of the promise of AI has changed since December to now. There have been no great breakthroughs to speak of that really changed the story of positivity in any kind of a meaningful way longer term.
Maybe.
So to me, this is just sentiment.
Maybe, but markets can stay irrational longer than most can stay solvent.
Yes, they can. Absolutely.
With that, Overtime's out of time for today. We'll be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after first call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. See you tomorrow. Of course, up next, after a break, Ilya's back with Macro Money. He's also here tonight for The Price of Truth with Victor Jones, 6 Eastern, 3 Pacific, so be sure to stick around for that too. Good luck trading.
See you there, everybody. Well, the markets take another quiet day to think about things as they wait for more event risk to hit the wires. We're, of course, still waiting to see how trade negotiations between the U.S. and China are going to go. We're still waiting for the start of economic data to really hit the wires this week. And that's what we're going to focus on here today on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And for the next 30 minutes, we're going to see if we can break down what will be the first big piece of economic data this week and whether the markets should care about it. And, of course, what we're talking about here is U.S. CPI data. We have in front of us what is the first kind of big piece of data for this week, and of course a week full of low volume drift in markets. So the hope is pretty much any place you might find yourself in the bullish bearish divide, that you get some conviction, that you get some sort of follow through and some kind of a break of the lull that we've seen here. So what we're going to do is go through and see what is expected, what that means going forward, and whether the markets should care. Now, the expectation here is we're going to get inflation ticking higher for the month of May, 2.9% expected on the core reading, excluding food and energy. That's the metric that the Fed cares most about, of course, because they don't really have much by way of agency over data that might speak to what's going on global food and energy markets. They can't exactly will those prices this way or that. And in any case, we can see from the breakdown here, almost all inflation for quite a long time now has lived overwhelmingly in core services. And so with that in mind, that's really the metric that we are most focused on here. And on that score, we are looking at the most significant inflation if we get expectations met here in 3 months, 2.9 would be a 3-month high, getting back to where we were, or approaching where we were in February at 3.1%. It's a similar story for the headline, 2.8% in February, 2.5% expected. Likewise, a 3-month high. Now, in April, these numbers were, from the market's perspective, certainly, encouragingly normal. And what you see here is the contributions to those numbers. You can see the headline was 2.3%, down from 2.4. The core was steady at 2.8. The core services component overwhelmingly the main contributor, but perhaps the most significant thing here was you didn't really get a surge in goods inflation, which is what you might have expected given all of the Fed's worrying about the onset of tariffs. And of course, in April, we very much saw a significant increase in tariffs, the pause in reciprocal rates beyond 10% notwithstanding. Taking that pause as it occurred, you still had a move from the average tariff being 2% to the average tariff being 10%. So you have a 5-fold increase in tariffs. And the worry was that what this would mean is a significant increase in goods inflation that would hurt consumption, that would give you a nudge on the part of the economy that is the most significant. We've talked a lot here on Macro Money about the first quarter being the weakest contribution from consumption to overall GDP in close to 2 years, while at the same time accounting for 68.5% of GDP overall, which is not what you want to see. Certainly, that consumption is the dominant thing is the standard for developed economies, but that's why you don't want it at a 2-year low. So the concern was that you'd start to see that show up in surging goods inflation, and when that didn't present itself in April's CPI numbers, this was met with a lot of encouragement by the markets until, of course, you got the PPI results and you saw where that inflation went. Here is the month-on-month change in wholesale inflation, excluding food and energy. And you can see we're looking at some of the fastest rates in April going back 2 years. There's that big errant spike in 2023. And if you look through it as a one-off, as it looks to be, then you're going back to kind of the worst of the inflation surge in 2022. For your reference point. But that didn't show up in CPI because you can clearly see here what's going on is businesses ate the difference. They basically took a hit on margins, and you see here the negative reading on month-on-month PPI here, and you can see it appear in what is called PPI for services. This is the trade services component, which basically represents the cost of moving goods through the supply chain once it's in the U.S. And you can see here the hit on margins and ends up being something like 1.6%, which is quite a big hit for a single monthly change. So that drop in margins tells you that, as you helpfully get annotated here from the chart, that I pulled from Bloomberg reporting on this, you get this hit to margins, and that's where the price increases have gone. That's how they're not, for the most part, in CPI. Now, looking forward, the ISM numbers that just came out last week tell you a story of very significant price pressure. It's evened out at a high level in manufacturing, apparently, over the past 2 months or so. That's somewhat encouraging, at least in the sense that things aren't getting actively worse. But in the service sector, you've had a dramatic catch-up. In fact, you are now looking at the fastest inflation, according to this ISM survey data, for services, which is by far the largest component of the economy. If manufacturing is maybe something like 20%, and ag is maybe something like 10%, then the rest is services. So about 70% of the overall economy. That's now at the fastest since November of 2022. Kind of comports with what we're looking at here in PPI, absent again this errant spike in 2023. What's more striking is that you get this runaway inflation at the same time that the sector contracts for the first time in, give or take, a year. You'd have to go all the way back, and granted it's a narrow contraction, but you'd have to go all the way back to December of 2022 and then to April of 2024 to get some recent readings below 50. And you can see here that, at least sort of referencing the middle of last year, this is the weakest that the service sector has been. And of course, manufacturing had this run up around the running of the tariffs, but now seems to have had that fizzle as the tariffs have gone from speculation to reality. And so it isn't as though you are getting this jump in service sector in inflation here against the backdrop of growth becoming stronger. That would be the kind of thing that's driven by robust demand and would be generally a source for optimism. That isn't what's going on here. Inflation is surging here at the same, and you can see the base here is the beginning of this year for the most recent bit. And of course, over the same time, what's happened with growth in the sector is it has been cooling. And again, this is the largest sector of the U.S. economy. So if ever you wanted a picture of stagflation risk, there it is. Moreover, that price component of the ISM services report has tended to anticipate with about a 2-month lag what happens in CPI, as well as the Fed's preferred gauge of inflation, the PCE index. You can see that obviously the ISM survey is more volatile, but you can see that in broad strokes, there is a trend following a kind of parallel set of developments here if you lag the PCE and CPI indices by 2 months. And of course, what that anticipates is if this now is an inflationary surge, most recently going into April and May, that should begin to show up right around the next several months in CPI and PCE, even if it doesn't show up necessarily in this month's data. So the risk is in the direction of reflation. And of course, these things aren't perfect. These relationships aren't one for one. So you'd have to set aside the idea that you know that this is going to happen this month, or you know that it isn't. What you do know, though, is there has tended to be this relationship, and